A big hello and warm welcome to my dear students. I welcome you back on the series of lectures on Economic Survey 2025-2026. Today we are going to tackle three very crucial chapters of Economic Survey, and these chapters are very important from UPSC perspective as well. In fact, I have filtered out the most important content from the Economic Survey of these chapters which are relevant for UPSC exam, especially focusing on the prelims aspects. So let us see what the chapters are. So the first chapter that we are going to study is external sector, which is chapter number 4. Here we will talk about trade, we'll talk about balance of payments. But the focus of the Government of India in this chapter this year is playing the long game, which is the Government of India is trying to say that short-term benefits are okay, a country requires that as well. But in the longer perspective, what should be the policies that the government should create so as to get the benefit from global trade? That is the theme of the chapter. The second chapter that we are going to study is services. You understand how important service is for the Indian economy. In fact, the highest contribution in India's GDP comes from services. Service is also contributing a lot in employment. So that is why service sector becomes very crucial for us, and India is considered to be a global leader in services. So looking at these perspectives, it is interesting to see what the blueprint of the government is for the next year so as to promote service sector in India. So it says services from stability to new frontiers. So we are trying to go to new frontiers from the stable and the conventional services that India was giving earlier, right? So this is the second chapter that we are going to study, which is chapter number 7. So bachcho, first is chapter number 4, the external sector balance of payments, and chapter number 7, which is services. There is another chapter which is also connected to services. In fact, it's connected to digital services. And that chapter is called Evolution of the AI, Artificial Intelligence Ecosystem in India, the Way Forward. Now, this is chapter number 14. So, we are going to do 3 chapters in this video. But we will start with the external sector balance of payment, then we'll go to services, and then we will go to artificial intelligence, and we'll see that what are the developments in these areas. So just like whenever we start a chapter, we always look at the layout of the chapter, that what is the content, and then we start to go into the details. So in this chapter, which is external sector, that is balance of payments, we have divided this chapter into 3 parts. In the first part, we are going to look at global scenario, and in the global scenario, specifically 2 things, the global uncertainty and the global trend related to balance of payments and trade. Number 2, we are going to look at the Indian scenario, and here we are going to look at first basics, that what is the basics of external trade and balance of payment. Then we are going to look at the components of balance of payment. For example, the current account. In current account, we are specifically going to focus on agriculture sector this year because the government has emphasized and said that this is something where India needs to work upon. The second component of Indian scenario is capital account. In capital account, we are going to look at FDI, foreign direct investment, foreign portfolio investment, and exchange rate, which has been in the news since last 1.5 years. We are also going to look at one interesting thing given in this chapter in the economic survey. This economic survey talks about relationship or correlation between current account deficit, depreciation and appreciation of rupee, and capital account. So the economic survey says that normally we consider that the relationship between current account deficit and the exchange rate is very intense normally, but this economic survey says that the relationship between current account deficit, movement of rupee, which is appreciation and depreciation, is important, but there is a third element which also affects these two, and that is the capital inflow or outflow, which is FDI and FPI. So we are going to see what is the relationship between them and how the government of India is trying to explain the depreciation of rupee that happened in India. So this is also very crucial. The third part of this chapter is miscellaneous items, where we get to know normally the health of the Indian economy in terms of balance of payments and exchange rate. So one of the terms that is explained very nicely in this year's economic survey is the net international investment position of India, where they are trying to argue that our net position is decent, it's not very bad or vulnerable. The second is external debt. External debt is something which every government in the world wants to keep in a controlled situation, because if this goes out of control, there could be a crisis-like situation in the economy. And the third is way ahead, that what should India do in terms of trade, in terms of balance of payments. So these are the areas that we are going to look into. Now let's start with the global context. Now see, this is very important. See, what are the 3 observations that we feel is very strongly affecting the global scenario related to trade? Observation number 1. You see, what has happened across the world is Normally, when a government makes policy for agriculture, their ultimate aim is to improve the situation of agriculture. Similarly, when a government makes policies related to industries, their ultimate aim is to improve industries like manufacturing, job creation, etc. But when the governments start to use industrial policy to achieve sovereign goals and targets, for example, I am US. I want that India should not purchase oil from Russia. So what will I do? I will start to say that if India exports any industrial product to US is going to put heavy tariffs on that. So what is US doing? US is using tariff policy, which is, taxation related policies, export and import. And US is also targeting the industries of India to achieve a geopolitical objective where the US says that it is in US sovereign interest to place itself dominantly in the geopolitical scenario by weakening the relationship between, suppose, India and another country, be it Russia or anybody. So if a country like US is acting in such a way that they are using industries related policies in order to improve their sovereign objectives and strength, that could have a repercussion not only in the relationship between US and India, but it would have a repercussion on the entire geopolitics of the world. So this is point number one, which has been observed recently, that countries are increasingly using industrial policies to achieve sovereign objective. That's number one. Point number two, intense competition for rare earth. We understand that rare earths are required for almost any advancement or advanced technology that a country is trying to achieve. Rare earth is required, starting from automobile to, artificial intelligence to spacecrafts, everywhere it is required. And we know that every country in the world is trying to get as much rare earth as possible. So based on what the requirement of this important rare earth elements are, the geopolitical and the trade related policies these days across the world are designed. Now let us look at the third thing which we are seeing across the world: weak regional and multilateral trade agreement. You see, across the world what used to happen was, for example, let's say India has signed a trade agreement with some countries of Europe, right? India EFTA. Similarly, suppose that there is a group called as ASEAN. They sign trade agreement with somebody. So these are regional trade agreements, multilateral trade agreements, where a group of countries or across the world, many countries come together to promote global trade or regional trade. This used to be the fashion across the world in last 15 to 20 years. Now what has happened is, because geopolitical interest has become more dominant, and because of that, what has happened is that the multilateral agreements and regional agreements have taken a backseat. So these are the three things that we see across the world. So how do we know that countries are using economics to achieve their geopolitical objectives and end goals these days? We know it through number one, which is mentioned in the economic survey. Number one is called as Trade Policy Uncertainty Index, and second is called as Global Economic Policy Uncertainty Index. What are these two? Now guys, what happens is, across the world there are some important newspapers. So what we do is we take the 7 leading newspapers across the world and we try to identify that in these newspapers, how frequently is the word trade related stress and friction being repeated, that there is uncertainty related to trade, trade is a problem. So we try to identify from some of the leading newspapers across the world that are they repeatedly using the word trade related friction and trade related uncertainties. If they are doing that, we say that there is certain problem related to global trade. That's number one. Because if there is a problem, countries would report it, right? That's number one. Number two is that you look at the global news related to trade uncertainty, but you also look at your own newspaper, that how frequently your own newspaper, like Indian newspaper, would talk about the trade related agreements or disagreements or friction, let's say between India and US, between India and China, etc. So how frequently it is coming in our own newspaper. So when you take the global scenario, the top 7 newspaper of the world, and you try to find out how many times they discuss the trade related issues, that index which captures this is called Trade Policy Uncertainty Index. And when you take your own newspapers and try to see how frequently they discuss the problems related to trade, that is captured in Global Economic Policy Uncertainty. And in both these indices, we have seen increasing use of trade related disagreements and trade related friction. There is an increasing number of mention of these things in these newspapers in India and across the world. That is how we know that there is a problem, right? So since we know that there is uncertainty in the world related to trade, what are the after effects of that? We have seen one or two things. Number one, we have seen that countries are using economics to achieve their geopolitical objectives, which means earlier there used to be some sort of coordination between countries related to trade policies or, related to, for example, let's say how the regional balance will be maintained in terms of trade. All these things used to be little coordinated, but now the countries have become decoupled. So I'll give an example to you. So for example, US says, I don't care if I feel that somebody is a threat to me, or if I don't like somebody's attitude towards US, I'm going to put heavy tariffs on them. I don't care whether strategically it should be done or not, but I will do it. So now what happens is, I am country 1, example US, there is country 2 China, there is country 3 Brazil, there is country 4 like for example India. Now all these countries are making policies which are in isolation with each other. This is called decoupling. So countries are not coordinating, right? So that's one of the problems that has happened. Number one, Number two is the protectionist instincts. Every country in the world is behaving with a selfish motive, and that selfish motive is that whatever I produce should only be sold, and from wherever I want, I will purchase from there only. And if anybody else is trying to sell to me, I am going to put heavy tariffs on them. So everybody wants to become a seller these days, because when you sell, you will get money, and nobody wants to become a buyer. So these things are also destroying the global coordination which normally used to exist, and people have become protectionist. So from globalization, we are moving towards the opposite of globalization, which is almost like deglobalization. Now, number 3 is bilateralism. So what has happened is, earlier 4, 5, 6, 10 countries used to come together, they used to sign a deal, and that used to maintain the regional balance. Now 2 countries will come together and they will say that I want that, I should benefit, you should benefit, we don't care for rest of the world. This is bilateralism. So multilateralism and global approach has given way to bilateralism, which in the long run is not a great thing, right? So what are we observing? We are observing a very short-sighted approach between countries, where global cooperation is being kept aside and we are promoting bilateralism. Decoupling of policies have happened. Countries don't coordinate now. These are some of the challenges that has happened across the world. Now, I want to ask you a question. In this situation, what do you feel will happen to the trade that a country like India does? Do you believe that India is going to be able to benefit a lot from export and import, or do you believe that there will be bottlenecks and challenges? What is your opinion? Absolutely right. I know you guessed it right, that yes, India is going to, not only India, but rest of the world, including India, since we are studying it from Indian perspective, of course we are going to be affected. So for example, earlier we used to export a lot of goods to some countries, now that would be affected. India used to export a lot of services, of course that would be impacted. Job creation would be impacted, and overall trade would be negatively impacted. In many ways, there would be some new friends also, but there would be problems also. It would be a mix, which means that the global situation is uncertain and little vulnerable. Let us go into the detail. Now, as I was telling you that there are certain signs across the world that countries have become increasingly decoupled and they have become little short-sighted. So there are 3 concepts. If you see these 3 concepts, you yourself will get a proof that yes, there is some problem across the world where coordination and cooperation is being removed and countries are becoming more short-sighted in their approach. I'll give an example to you. So Bacho, there are 2-3 terms which you should know from UPSC perspective, both prelims and mains. The first term is called nearshoring. Right, this is the first term, nearshoring. Now, there is a second term which is called as friendshoring, and there is a third term which is called as trade concentration. So, nearshoring, friendshoring, and trade concentration. These 3 terms are important. What are these 3 terms? Now, imagine that US, for example, starts to say that I want to buy agricultural products and I am only going to buy it from Canada. The same agriculture product, for example, US was buying earlier from India, but US now starts to say, I don't want to buy it from India. I will buy it only from Canada. So when you start to do export and import or trade with countries which are close to you geographically, which means here geographical proximity is important. Here quality of product is not important. So let's say that they were buying some chocolates from India and now US starts to say, I'll only buy it from Canada, despite the fact that Canadian chocolates are not superior to India. Indian chocolates are superior, but they'll buy it from Canada. Now that's called as, nearshoring. Nearshoring means geographically you are looking at those countries which are close to you and you are doing trade with them. Now, number two, there is another concept called as friend shoring. What is the meaning of friend shoring? So, for example, if US was earlier buying, let's say for example, coffee from India. Now, US starts to say that I will buy coffee from only my friendly countries whose political alignment is matching with US political alignment. So, for example, US would say that US feels very comfortable politically connected to European Union. So, US will say that I'm going to buy the coffee from European Union and not from India. So, when you start to do trade with those countries with which you have political alignment, that is called as friend shoring. Right. Now, in friend shoring also, you don't look at quality, you look at those countries which are politically aligned. So, again, trade aspect is secondary here. And what is the primary objective? Strategic alliance. Now, third is called trade concentration. Trade concentration means, for example, US says that earlier US used to do trade with almost every country in the world, but now US starts to say that I will do trade only with a handful of countries. For example, I am ready to do trade with Brazil, European Union, UK, but China, India and all those countries which US feels is a threat, US will say that I'm not going to do more trade with you. I'm just going to do minimum trade with you and maximum trade with only a group of countries. That means trade will be concentrated in a group of countries. So when these three activities happen across the world, we know that the world is fragmented and long-term sightedness is gone. And world has become more uncertain and decoupled. So let us see actually what has happened across the world. Are we observing these three things? If you look at the graph in the economic survey which has been given, you will realize that friend shoring and trade concentration is happening across the world. See, near shoring is literally almost controlled. So now countries are not only looking at geographical proximity, countries are looking at political proximity. So what are the two things that we observe across the world? Number one, we are observing more of friend shoring, which means political alignment. And number two, we are observing more of trade concentration, that is trade happening between a group of countries. So now, bacho, we are going to look at India's trade review, overall review of India's balance of payment and trade. Now, let's quickly revise. This is called as balance of payments. Now, balance of payments, there are two important elements. The first is current account, second is capital account, and connected to the capital account, you have official reserve account. And what is official reserve account? The forex reserves of India, right? Foreign exchange reserve, where you have SDR, you have reserve transposition, gold, and foreign currency assets, right? So, what are the things in forex reserves? Foreign currency assets, SDR, gold, and reserve tranche position, right? Now, let us look at some of the details related to current account. So, in current account, you have the first thing which is merchandise that is visible. In merchandise, we have export and import. Now, what are the important things that India exports and what are the important things that India imports? So, economic survey mentions that when you take goods in India, the goods can be divided into three parts. Number one, so for example, let's say we are taking all the goods. Goods can be petrol, oil, lubricant. So, we import crude oil, then we refine it and we export petroleum, petrol, diesel and other products like chemicals and all, right? So, we import crude oil and we export the petrol and diesel. Number two, we import, for example, gold and silver. And what do we export? Jewelry, right? Number three, so since we have already divided goods into petrol, oil, lubricant, gold and silver and jewelry, so whatever is remaining can be called as others, right? Or it can also be called as non-POL, non-gold and silver, non-jewelry. These things we can say. So this is how the government has divided the balance of payments from Indian perspective. If India would not have been importing crude oil, so for example, India itself had sufficient crude oil, then in import we will not write POL because India is not importing. Since we do import, that's why we have written it. So that is called as merchandise goods. Now let's look at non-merchandise. Non-merchandise is invisible, which you can't touch and feel. So the first thing there is services. We understand that India is a service-led economy. And number two is transfers, like remittance. So suppose that somebody is sending money from outside India to India. So you know that a lot of Indians go to countries like UAE, Middle East, US, Australia, and from there they send money to India. So that is called remittance. And we are a country in the world which receives the largest amount of remittance. So those transfers are mentioned here. And then you have income. So, bacho, this is very important. For example, as an Indian, I buy the share of other countries' company. So there is a company in US and I bought the share. So what will I get? I'll get dividend. Similarly, I invest in the bond of other countries, I'll get interest income. I buy a property outside India. Let's say I buy a house in London, I'll get rent from that. So that is called as income. But similarly, the foreigners also buy house in India, the foreigners also buy the shares in India, and the foreigners also buy bonds in India. They also get income in India. So what is important here is net income, which means how much income the Indians get from outside and how much income the foreigner get in India. We look at both the perspective. Okay? So that is called as invisible. Now you have capital account. In capital account, what do you find? You found foreign investment, which is FPI, FDI and depository receipt. Then you have loans, external commercial borrowing, IMF, etc. These are the loans actually which we take. Then we have banking capital. What is the meaning of banking capital? Foreign currency assets, NRI deposits. These are banking capitals. And mind you, these NRI deposits, when they deposit money in India, we have to return this money to them also, right? Because that is their money. They deposit it in various accounts in India. For example, we call them as NRI account, right? NRE, NRO, non-resident external account, non-resident ordinary account, FCNR, foreign currency, non-resident savings account. So all these accounts are there. Then rupee debt service and other capital. These are the components of capital account. Now that we have understood the components, we can go and see the details related to them and the development. You must be knowing that historically what is true for India is that India is a net importer. So what we do is we import a lot of goods, we import some services also, and we pay huge amount of money. So when we import, what do? We pay money, and when we export, we get money. But this is the money which we receive, this is the money which we pay. We always pay more, we always get less. So the normal situation in India is that India almost all the time, barring some exceptions, India faces a deficit in terms of trade. This is our problem. So what we are trying to do in India is we are trying to minimize this deficit, because when you purchase, you will pay, and when you sell, you will get money. We always get less money. So we are trying to see that what is the government of India trying to do to correct these problems. So let us see the trend first, and then we'll see the correction. So, there is a graph which is given in the economic survey, and the graph says that this talks about merchandise export, merchandise import and trade deficit. Remember merchandise, so in current account you have merchandise and you have non-merchandise. So first we are going to look at merchandise. So see what has happened in India. This is from 2019 onwards. So this is before COVID. Before COVID till now, see what is the trend in India. You will always see that our export, this is our export is here. Our export is always below our import. This is import. You will always see that import is higher than export. Export is lower. Here also you can see that this is our export, this is import. This is export, this is import. And the difference between them shows that how much is our deficit, how much is the gap. So that is called as trade deficit. So see carefully, bacho. If you look at the year 2024, see this is our export and this is our import. Our trade deficit is minus $283.5 billion. Now, let's look at comparison. Let's look at the export and import between April to December 2025 and April to December 2024. We are going to compare this time period. So, if you compare April to December, right? Why? Because this economic survey chapter was written in January, so they are not giving the figure for January. So if you compare this, you will see that our trade deficit in April to December 2024 was minus 224. Minus 224, this was the deficit, minus $224 billion. Now our deficit has increased to $248 billion, which means that what has happened? Our export and import gap has increased, which is not a good thing. Now, does it mean that we are doing bad in export and bad in import in everything? No. See something carefully. Earlier, this was our, import. Currently, this is the import, which means import has increased. Now, look at the export. This is our export. This is our export. Export has also increased. Both have increased. But what has happened is import has increased faster. Import is increasing faster, which necessarily might not be a good thing. So, here we try to see just which is growing fast. To see what is happening. This is export and this is import. First, let's look at the overall picture. if you look at the overall picture now, you will see that the growth rate of export is 2.4% and the growth rate of import is 5.9%. So which is growing faster? Import. That is why what do we have? Trade deficit. And what is our deficit value? Trade deficit $248 billion. Just remember this, okay? Because we have seen it now. See, $248.3 billion. That is what we have written here. Now, the government of India has mentioned that what are some of the items that we are exporting and are we doing well in some of the items? That is what we have to see. So see guys, in export, the government of India has mentioned in the economic survey that non-petrol, non-gold and jewelry, which means gold and jewelry has not been doing that well. Petrol is also not doing that well, right? Gold, jewelry and petrol, they are not doing that great, but things which are non-petrol, non-gold and jewelry, they are doing well in terms of export. India is exporting those things more now. So which are some of the items which you are exporting more? Non-petrol, non-gold jewelry. For example, electronics, mica, coal, minerals and marine products. These are the things that we are exporting more. And look at the rate of growth of export, which means their export is rising at a very high value. For example, in the year 2024, let's say, 2024, we exported electronics worth $100 billion. Example. In the year 2025, we are exporting worth $135 billion. So this is the rate of growth. So rate of growth of electronics 35%, mica, mineral, marine is more than 15%. So these are our good exports which happened in the year 2025. Right. So what will you answer in UPSC if they ask you the question at which exports India did well? So we will say that India did very well in some of the exports like electronics, marine, coal, minerals, right, which means these are the exports which are not related to petrol, non-petrol, non-gold, non-silver. Now, what about import? What are we importing? So see, we have mentioned here that non-petrol, non-gold, non-jewelry, these imports increased at 9.5%, right. So which means that those things which are not petrol, those things which are not related to petrol, not related to gold, silver, their rate of growth of import is 9.5%. The imports is increasing at a rate of 9.5%, especially non-petrol, non-gold and non-jewelry. Now, since we are taking non-petrol, non-gold, non-jewelry, let us see the components which India is importing a lot. So, for example, electronics, some of the heavy electronic items, costly electronic items, India is importing a lot and its rate of growth of import is 17%. That's very high. Now, machine, electrical, non-electrical components more than 17%, chemical 45%. So, rate of growth of import of chemical is 45%. So, these are the things which we are importing around. Because of these things, our rate of growth of import is very high, right. So, what did we observe? We observed that our imports are growing sort of faster than export, and in import also there are some items which India is importing a lot. For example, costly electronics, machine, electrical, non-electrical and chemical. Chemical is being imported at a very high speed. That is what we have observed. Now, there are 2-3 things that we should know about India here, very crucial from prelims perspective. Point number 1, if you look at the time period between 2005 and 2024, let's look at this time period. You will see that India's share in global merchandise export. What is the meaning of merchandise export? Export of goods. So, India's share in global merchandise export increased from 1% to 1.8%, which means that if across the world, the value of exported goods is equal to $100 billion, India's contribution in $100 billion worth of export across the world, India's contribution was $1 billion. In the year 2005. What is India's contribution in the merchandise export across the world now? It is 1.8%. So, out of $100 billion worth of global merchandise export, India's contribution earlier was $1 billion, now it is 1.8, which means India's contribution in global merchandise export has nearly doubled between 2005 and 2024, which means in 20 years. Now, there is one thing which is good about India. What is one good thing about India? That India has improved its trade diversity, which means that overall trade. And what do you include in trade? You include both goods and services. So, overall sense, India has become more diverse, which means that earlier India was exporting, let's say, only agricultural products. Now, India is also exporting along with agriculture, services, some manufacturing items, electronic items. So, yes, it has become diversified. Earlier, India was trading with only few countries. Now, India is trading with more number of countries. So yes, overall diversification has happened, but what has not happened in India at a good pace? So the diversification specifically for merchandise has not happened a lot, which means that we don't have too much variety related to goods. India still has limited amount of goods. Mostly we deal in services. And number two, when it comes to export of goods, we don't have too many countries with which we trade. Our relationship mostly is confined to services. When it comes to good, the variety of goods is also less, and the number of countries with which we trade in goods is also very less. So which means that we need to improve merchandise trade, okay? We need to have more partners, we need to have more goods. Now, let us look at some of the things which are happening in agriculture. So, bachcho, first I want to show you the graph. See, graph always looks little daunting and difficult, but when you decode the graph and convert it into sentences, it becomes very easy. So, see here, what are we seeing? Trends in agricultural export. And what are we mentioning here? Agriculture export and share in merchandise export. First, we'll talk about agriculture export. So, see what is happening from pre-COVID till now. What is happening to agriculture export? See, it was increasing. Then it became constant, which means between the year 2022 to 2024, agriculture export more or less stagnated. That is one thing. Now, why does something become stagnant? Maybe we are not able to fulfill the requirement that the world has, or maybe those buyers who used to buy from India, they are buying from elsewhere. Or number three, maybe India lost some new markets which we were supposed to get. That's why we stagnated. Who knows? We'll see. Now, if you compare April to November 24 with April to November 2025, you will see that our agriculture export has slightly increased. So, that's a good thing. Now, number two, if you see share in merchandise export. So, bachcho, for example, this is our BOP. This is our merchandise export, right? In merchandise, suppose that merchandise means export of goods. So, suppose that India is exporting goods worth 100 crore rupees, right? So, denominator is 100 crore. We want to know that out of this 100 crore, how much is the contribution of agriculture? So, that is called as agriculture share in merchandise export. So, let us see. So, guys, if you see carefully, you will see that earlier the share of agriculture in merchandise export was very high, then it started to come down and now it has almost become stagnant. And if you see now also, the share is roughly around 11.3% to 11.8%, which means we are 11 to 12% only. So, which means if you take agriculture export upon merchandise export, the value of this ratio is somewhere around 11 to 12%, which means that if our merchandise export is 100 crore, agriculture is contributing around 11 to 12 crore. Is it a great thing? Well, it would have been good long time back, but now it should improve. It's not improving. So, let's go back and see what is happening actually. Let's look at some of the figures now. Now that we have read the graph, we should know some of the trend. So, see, if you take the time period between 2019 to 2024, what do you observe? You observe that the rate of growth of merchandise export is 6.9%, which means our merchandise export is growing. Merchandise means goods. The export of goods out of India is growing at a speed of 6.9%. Rate of growth of agriculture export is 8.2%, which means that overall agriculture export has been increasing in terms of rate of growth, right? Overall, average, not year to year, but overall average. And you know why this average is high? Because 2019, 2021, at that time we were doing well. Now we have started to go a little down. Now, what is the share of agriculture in merchandise export? 11 to 14%. So, our contribution of agriculture in merchandise export has become stagnant, 11 to 14%. Now, between the year 2022 to 2024, see what happened. Between these 2 years, recent times, Indian agriculture export has stagnated. See, Indian agriculture export has stagnated, whereas if you see across the world, you will see that global agriculture export has increased, which means across the world, people are buying more of agricultural products, but India is not able to contribute. That means something is wrong. So, in India, Indian export has stagnated, but global export has increased. Now, let us see something. India's share in global agricultural export. So, what is India's share? So, if across the world, the value of agricultural export is, let's say, $100. Across the world, the value of agriculture export $100. What is the contribution of India? In the year 2000, contribution of India was 1%. In the year 2024, contribution of India 2.2%. Not a good thing. The reason being that if you look at these last 25 years, our contribution of agriculture in the global export has just increased from 1% to 2.2%, despite the fact that India is considered to be an agricultural country. It's not a good thing. That means there is something wrong. If you look at the production of India, India is one of the largest producers of literally many products, agricultural commodities. But when it comes to export, we are not one of the largest exporters in the world, which means there is some problem. You know what we should be doing? We should be creating more of, cash crops. We should also be converting the raw material of agriculture or raw crops of agriculture into some processed food also, which means that food processing needs to improve. The type of crop that we are creating, we also should create high value crop, and we also should look for new markets. You know what is the problem in India? I'll tell you. The problem in India is we mostly create agricultural policy in and around the food security of India and the inflation management. For example, when inflation is high, government of India will start to, sell the food crops outside. The Food Corporation of India go downs. We'll take the crops outside the go down, rice, wheat, etc., and we'll start to sell it. Which means that mostly we have reduced our agricultural policy to food security through National Food Security Act and inflation management. But we should also focus on a third aspect. If we are able to export agricultural commodities outside India and get good money for that, our farmers' income will improve. That is something which we have not been able to do. So, having a focus only towards inflation management and also food security is not a good idea. The reason being that a third element is missing, which is export-oriented policy along with food security and inflation management, so that these three things will go together and farmers' income can also improve. And Bacho, there is one target of the government of India. So you can see that if you look at the value of export today, like for example in 2024, what is the value of export from agriculture? Around $51 billion. But what is the aim of the government of India? That by the year 2030, the government wants that the value through agricultural exports should reach $100 billion, right? So currently we are half of that, around 50, want to make it 100. Now, we are coming to services. So, Bacho, overall we have seen what has happened in merchandise. So, in merchandise, our import is higher, our export is lower. So, there is trade deficit. And what is the value of deficit? $248 billion. Now, we are looking at non-merchandise. In non-merchandise, we are going to look at services, transfer and income. We'll start with services. So, Bacho, this is the graph which is given related to services. As you can see, this is service export which is rising. Service import is also rising, but export is rising fast, import is rising slow, and there is a surplus, right? In service, there is surplus. Similarly, if you compare April to December 2024 with April to December 2025, you will see that service export is more than import. Here also service export is more than import. And what is the surplus? Because of services, $135 billion. Here it is $151 billion, which means that in services we are having surplus. But UPSC will not ask you this. UPSC will ask you these things. These are important, right? So let us see what happened to India for the year 2025. Now, rate of growth of service export in India 6.5% April to December, and rate of growth of service import is 1.5%. So service is growing. Why? Because we know that export is higher than import, which means in services export is greater than import. See, 6.5 greater than 1.5, which means that there is service trade surplus. Now, what is the trade surplus in services? So, Bacho, if you see carefully, see, this is the surplus. In fact, if you want to look at 2025, this is surplus. If you want to look at April to December 2025, $151 billion. This is the surplus in trade. And what did we observe? That what is the overall deficit in merchandise? The deficit in merchandise was roughly around $248 billion. Okay. So the economic services, listen to this very carefully. Economic services that if India faces a deficit in terms of merchandise, merchandise means export and import of goods. So we know that our import of goods is higher, export of goods is low. So whenever we face deficit in merchandise, suppose that the deficit is $100 billion, that means there is $100 billion shortage whenever we are dealing in goods. So whenever India faces a shortage of $100 billion, when it comes to trade in goods, out of this $100 billion, $61 billion or roughly around $60 billion is provided by services to help us, which means in terms of goods, we always face the deficit because our export is less, import is more. But how are we able to import more? We are able to import more because service sector provides us the money. How much money is provided by service sector? So whatever is our merchandise deficit, out of that, roughly 60% is provided by services so that we can arrange this money to import goods. So see, the economic survey is saying that roughly 61% of merchandise deficit, and what is our merchandise deficit? Roughly around $248 billion. So that is roughly provided by services. Now, which are some of the top services which are exported out of India? So this is also given in the economic survey, important for the exam. Software, business processes, management, consulting, fintech. So 1, 2, 3, 4. These are the 4 services in which India has done really well in last 1 year in terms of export, right? So software, BPM, consulting and fintech. Now, especially out of these 4 as well, software and business processing, in these 2 we have done slightly better compared to other services. So in these 2 services we have done even better. So which means that we are doing really well in digital kind of services and knowledge kind of services. Now, India deals with multiple countries when it comes to services, but India's trade in services with US has come little down because you know that US has put so much restriction, and India's trade in services with Europe has actually increased. So India is exporting little more services to Europe now at a higher pace. That means India's engagement with Europe in terms of export of services has actually improved, and India's engagement with US in terms of export of services has come little down. These are the trends. Now let's look at overall current account, because we have seen the merchandise, we have seen the services. Now let's look at the overall current account and its components. So see carefully, bacho. This is how India's current account looks like. See, the first is net merchandise. Merchandise means trade in goods. So what has happened to net merchandise? See, if you look at FY25 to FY26, what is FY26? It's talk about 2025. And what is FY25, 2024? Let's look at these 2 first. So you can see that our net merchandise has gone down. See, it has gone down. Now, what about net income? So net income would mean that, for example, if Indians invest outside India, let's say I buy a house in London, I'll get some rent. If somebody from US or UK buys house in India, they get rent in India. So who is getting more income? Indians are getting more income outside India, or rest of the world is getting more income in India? Actually, rest of the world is getting more income in India. They are investing in India and they are making more income. So that's why you will see that our net income is also negative. This line is 0 line. These 2 are below 0. That means our net merchandise and net income are negative. It's going down, right? Which means we are paying more. Now, let's look at remittance. Net transfer means remittance. This is remittance part. So see, remittance is increasing, and you know that India gets a lot of money from outside. You know, earlier, where were the Indians going? Mostly earlier, the Indians were going to Middle East, you know, countries like, OPEC countries. But where are the Indians going now? Indians are mostly now going in advanced economies like US, UK, UAE, right, Australia, Europe. So earlier, Indians were mostly doing the low-skilled job across the world, like in oil-producing countries, Middle East, Arabia, right? But now Indians are going mostly in the skilled labor force segment. They are also going to Middle East, but they are also going to advanced economies to do the skilled labor force, right? In Silicon Valley, for example. So the quality of Indian migration has diversified now, okay? So that's why more remittance is coming. And net services, right? Which means that India imports some services, India exports some services. Our export is higher. We are net seller of services. So this is net export. These 2 are higher. So what is current account balance? This is current account. What is the meaning of current account balance? Current account balance means balance in merchandise plus balance in invisibles, right? These two. Our merchandise is negative, right? And in our invisible, you can see that our net income is negative, and you can see also that, for example, our remittance and net services, these two are positive. Remittance and services, these two are positive. So merchandise is negative. This net income is also negative. So negative part is heavy. So what's the only two positive part? One is remittance is positive and services are positive. These two are positive. So this is the negative part. These two are the positive. So these two positive part, what they do is they reduce this negative part. So for example, let's say that this is merchandise trade, and this also contains net income. In current account, our merchandise is negative, our net income is negative because we give more income to others. So when things are negative, it goes down. So it's going down. Because merchandise is negative and net income is negative, it's going down. But our services are positive and remittance are positive, so they push it little up. So it's going down, 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 but our remittance is pushing it little up and services are pushing little up. So that is what is seen here. So you can see that our current account balance is always negative. Sometimes it becomes positive, but mostly it is negative, negative, negative. But what is that one factor or two factors which is making it less negative? Otherwise, though, it would have been here. Our current account balance would have been negative like this. But why it is not negative like this? Why is it becoming slightly better? Because we are exporter of services, net exporter of services, and we get remittance. Because of these two, the current account balance looks little better. So that is what is mentioned here. And as you can see, that this is our remittance. So see how remittance has increased over the years. So in our current account, what are the things that you learned? So for current account, you learned that our exports are increasing, but imports are increasing more. And we learned that our merchandise trade is negative. We also learned that our net income is negative. And our services and transfer, these two are positive. So we learned that this whole current account would have been very, very negative. But its negativity has been reduced a little bit because of services and transfer. Right? This is what we have learned so far. Now, bacho, we are going towards capital account, and we have seen what is there in the capital account: foreign direct investment, foreign portfolio investment. These are major things in the capital account. So let's look at the capital accounts across the world. So if you see across the world, we are looking at the global FDI. FDI means foreign direct investment. That what is the trend of foreign direct investment across the world? So as we can see, that if you look at the global scenario, we are comparing 2023 with 2024. So this is given in the economic survey. So you can see that between 2023 and 24, globally, the FDI reduced by 11%. That's why it's minus 11. But if you look at the developed countries, the reduction is minus 22%, Europe minus 58%. And if you look at Latin America and Caribbean, minus 12%. But if you look at Asia, the reduction in FDI just 3%. And in fact, if you look at developing economies in total, all the developing economies taken together, it's not reduction. Actually, it's an increase of 0.2%. North America, 23% increase, and developing economies, 0.2% increase, which means that we can conclude from here that global FDI came down, but the FDI in the developing countries was more resilient. It was able to maintain itself. And if you look at Asia, only Asia, the FDI declined, but the decline was not very prominent. So in developing countries, situation is slightly better, but in developed countries, most of the developed countries like, in fact, US, UK, European Union, China, the situation was not very good. It could have been slightly more better, but it was not very good. And because of the uncertain policies they followed, this problem happened. So the FDI in developing countries, actually overall the developing countries increased and the developed countries reduced by minus 22%. And especially the problem happened mostly because of Europe and China. Europe and China, the situation is not that great. US somehow was able to maintain, but Europe and China was not. So now we are looking at the trend of FDI, that what happened in India's foreign direct investment. So now let's look at something interesting. So now see guys, so what has happened is 2-3 things which I want to tell you here. So this is India, okay. So now that from outside India, FDI is coming, right? So when FDI comes to India, let's say $100 comes to India, and let's say you belong to US and you are putting $100 in India. Why would you put $100 in India? Because you want some returns from India. So if $100 are coming in India and you are buying, let's say, shares, or you are buying properties, or you are buying companies, won't you look at how much profit you are generating? So if you are putting $100 in India, and suppose the return, numerator is the return you are getting. So let's say the return you are getting is high compared to rest of the world. So suppose that return is, let's say, 7% or 8%. Whereas if you put your $100 in other countries, same $100, it gives you a return of $2, which means 2%. Where would you go? Obviously, you will come to India. So there are 2-3 things that are important to note here. Number one, how much money is coming in India, right? So that is called as inflow of dollars. So we want to check whether it has increased or not. So that's number one, that how much dollar is coming to India. If dollars are coming to India, when people make profit in India, they take their money away. So for example, you are a US citizen, you invested $100 in India and you made a profit or return of 8%, $8, you will take it away. That is called repatriation. Right, that is repatriation. So I want to ask you a question. Suppose $100 are coming to India, it's a good amount, and repatriation is also good, which means dollars are also going out of India. Good news, bad news. In one aspect, it is not good that the profit they generate in India is going out, but it's a good news also. Why? Because now it will send a message across the world that if you put money in India, you get very good return, which you can take out, which means more FDI will be attracted. Now, other countries will also send their currency to India. More dollars will come. Why? Because they know they are making good returns, and India is not putting restriction on them on the returns. They can take their returns back, which means repatriation is allowed. So if the value of inflow of dollar is high, and if the value of repatriation is also decent, right? So if somebody is getting a return of 8% in India and they are taking away 7%, it's a good thing. It sends a message across the world that, wow, things are fine. But suppose, now what happens is, across the world there is global uncertainty, and in India there is relatively more stability. The government policies are a little more stable compared to US, UK, because they are going through more vulnerable times. Every day they are fighting with somebody. But suppose India behaves in a more mature manner, example, or China behaves in a more mature manner. Now what will happen? Whatever dollar is coming to India, $100, they will get a return of 8%, $8. If India looks more stable compared to other countries, will the investor take away this $8 from India? No. Earlier they were taking entire $8, now they will take $5 out of India, but they will put $3 in within India. Right, this is what will happen. So whatever I told you actually is happening in India now. So let me show you. So see, what is happening in India is, let's look at this. See, so we are looking at the year 2024 and we are looking at the year 2025. Now, this is net FDI to India. So see this line, this is net FDI to India. So Indians are investing money outside, outsiders are investing money in India. But how much money India is getting? More. So net FDI to India is this. This is the money that we are getting in India in terms of investment. And the net FDI by India. So how much money is India or Indians or Indian companies, how much money are they investing outside India? This much. And how much money outsiders are investing in India? This much. So which is higher? The money that is coming to India. So that's the first news. Number two, this line that you see, this one and this one, this shows repatriation. So the repatriation level is very high, right? But we see that the repatriation has come little down between 2024 and 2025, which means repatriation is high only. High in the sense that whatever people are earning in India, foreign investors are earning in India, they are able to take it back. But now they are not taking a lot of money, they are putting some money in India also. Why? Because global situation is not very good. So more money is coming to India through investment, and whenever the foreigners are making returns, they are not taking the entire money with them, they are putting some money in India also. These are some good news. And how do we know that they are putting money in India? Because This graph has been given by the government, which shows risk-adjusted return on inward FDI, which means whenever a foreigner is investing in India, let's say they are investing $100 in India, how much return are they making in India? See, 7.2%. So if a foreigner is investing $100 in India, net amount they are able to generate in India in terms of return is, adjusting for risk, they are able to get $7.2, which is one of the best in the world. If you look at Indonesia, it is higher than India. It's somewhere around 10.5%, but India 7.2%. That is the reason that whatever profits they are getting in India, they are not taking entire profit away. Some of the returns they are keeping within India also. So what do we observe for India? That what happened to FDI? We see that this line is gross FDI, that our FDI is now increasing between 24 and 25. The FDI is increasing. People are investing money, the investors are making returns, and they are not taking the entire returns with them. This is what we learned, right? Now, there is one interesting thing which has been given in this year's economic survey. What is given? I'll show you. So, for example, let's say these are developed countries. These are developing countries, these are low income countries, right? So we are dividing the world into 2-3 types. The first is developing, this is developed, this is developing, and these are low income countries. Now earlier what used to happen was, suppose $100 were invested across the world in the name of foreign investment, which means that some of the people in developed countries used to invest money in developing countries. These people also used to invest here. So this total investment used to be $100. Mostly it was coming from developed countries. They used to be the foreign investors. Now what has happened? If across the world $100 are invested, who contributes in this $100 foreign investment across the world? Now developing countries are also investing across the world, which means suppose this is India. Is India investing in countries like Sri Lanka? Yes. Is India investing in Singapore? Yes. Is India investing in Bangladesh? Currently no, but yes, normally. Does India invest in US? Yeah, we do. In UK? Yes, we do. So now, not only developed countries invest in developing countries, not only they invest here, but we also invest there. We also invest here. So what has happened across the world is, it has been observed that out of total investment, so suppose in the world $100 have been invested in the nature of foreign investment. So now what has happened is, roughly around 70% of the investment, global investment in foreign investment comes from developed countries, but roughly around 30% investment also comes from developing countries. But if you look at the year 2000, 25 years back, so roughly around 93% investment across the world used to come from developed countries and roughly 7% from developing countries. Now this 93 has become 70, this 7 has become 30%, which means, can we conclude that we are seeing an increasing trend of global investment by developing countries? So developed countries are also investing in other countries, but developing countries are also investing, which means out of the total foreign investment in the world, the contribution of developed countries is roughly around 70% and the contribution of developing countries is roughly around 30%. So ratio is 70:30. So developing countries are also investing. That is one part. Now, is India investing? Yeah, India is. So where does India invest? So let us see, where does India invest? This is called as outward FDI. Right. So where does India invest? If you look at the total investment of India, let's say India is investing $100 billion every year. Out of $100 billion, where is the maximum investment of India going, maximum FDI of India going? So you will see that maximum FDI of India goes to Singapore. We invest in Singapore a lot. We invest in USA. So our share of investment, so let's say that India total invest $100 billion every year through FDI in other countries. Out of that, 27% goes to Singapore, 16% to USA, 10% to UAE, Mauritius 9%, Netherlands 7%, and UK 7%. So if UPSC will ask you which are the top 5 countries in which India invests in terms of FDI, top 5 countries. So name of top 5 countries would be Singapore, US, UAE, Mauritius, Netherlands, and UK. These are the top countries of the world where we invest. Now, there is one more trend which is given in the economic survey. You know that foreign investment can be of various types, like FDI, like foreign portfolio investment, right? So in FDI, we have seen the trend. What happened to foreign portfolio investment? You understand that foreign portfolio investment is more volatile, right? So what is the difference between FDI and FPI? Foreign direct investment is mostly for stable purposes, long run. Like suppose some foreigner comes to India and buys a company, that is FDI. But suppose a foreigner comes to India and only buys little bit of shares, little bit of bond, that is called FPI, foreign portfolio investment, right? So whenever somebody makes an investment of less than 10% in Indian companies in shares, that's FPI. So what happened to foreign portfolio investment in India? Was it stable? No. It was going up and down, which means the trend was fluctuating. So if you look at FPI, in FPI we saw fluctuation, and we saw two things in FPI, that there was a decline in investment in shares also, there was decline in investment of bonds also. So in FPI, number one, fluctuation, number two, decline in shares and decline in bonds. Now, what about the Forex Reserve of India? So if you look at the Forex Reserve, remember when we started the lecture, we discussed the components. So this is the Forex Reserves of India. What are the components of Forex Reserve? Foreign currency assets, gold, SDR and reserve transposition. So if the Forex Reserve of India is $100 billion, for example, in that 88% is FCA, 8% gold, SDR 3% and RTP roughly 1%. So look at the Forex Reserve of India. So if you look at the end of 2025 or beginning of 2026, you will see that India's Forex Reserve was $701 billion. It's a record figure, 701. But what is the composition? As you can see, that the FCA, foreign currency asset, is the maximum C, 88%, followed by gold 8%, right? Followed by SDR 3% and RTP. But what about the trend? As you can see that between 2025 and 2026 here, the foreign currency asset came down, which means that its share declined. What happened to the share of gold? RBI purchased a lot of gold. Why? Because whenever there is global uncertainty, the central bank across the world start to buy more gold. They feel that the gold is more safer. Then what happened is SDR was almost stable, not much change. And this was slightly, it increased little bit. If you look at the real figure, it's not 1%, it's somewhere around 0.89 or 0.9%. But I have taken as the round figure 1% just so that you can memorize it for UPSC. So RTP also increased, this was stable, this increased and this declined. This is your Forex Reserve. Now what happened to the exchange rate? Let us see the exchange rate scenario in India, very interesting. Now see, so what happened in India is, there is this graph. What does the graph tell us? See, if you look at the year FY10 to FY15, which means we are taking 2009 to 2014, and this is 2014 to 2019 pre-COVID, and this is 2019 to 2024. Okay, so if you take these 5 years, 5-year time period, you will see that rupee fell means depreciated. Rupee depreciated against dollar. Continuously there has been depreciation. Earlier $1 was equal to 45 rupees in the year 2009. Now $1 crossed 90 rupees also. $1 became 91, 92 rupees, right? So continuous decline is there. But what is the percentage decline in the value of rupee compared to dollar? So in these 5 years, 2009 to 2014, the rupee declined by 38% compared to dollar. Between the year 2014 to 19, the rupee declined 20% compared to dollar, and between the year 2019 to 24, the rupee declined roughly 13.5% compared to dollar. But if you look at the year 2025, specifically if you look at the year 2025, you will see, as the economic survey mentions, mostly if you look at the year 2025 and little bit of 2026, in 8-9 months, you will see that rupee has declined close to 5.5 to 6% compared to dollar. Why did that happen? So economic survey says that whenever rupee decline against dollars, there could be multiple reasons. For example, earlier, let's say that lot of dollar was coming to India and this is rupee. So when more dollar comes to India, because FDI comes, FPI comes, etc. Right? So more dollars are coming to India. Then there will be a balance between dollar and rupee. But many times what happens is, suppose that global trade is not happening or there is some instability in India because of which dollars are not coming, then the value of rupee will go down. But recently what has happened is, since the year 2025, trade war has started. And we have seen that how the country's geopolitical policies and objectives became dominant compared to economic objectives. So what has US and some other countries in the world done? They have started to put restrictions on India. Earlier, India was able to export. Now, there are many items like textiles which we are not able to export. So dollars are not coming. So first of all, through trade, dollars are not coming, number one. Number two, there has been global uncertainty. So even foreign investors are very cautious. They are coming to India, but more dollars would have come. So more dollars are not coming. We saw FPI is going out of India. FDI is coming, but foreign portfolio investment is going out of India because they don't want to come in uncertain global scenario. So what has happened is trade route has been impacted. FPI has been impacted. So dollar is not coming. So the size of the dollar circle has become smaller like this. But Government of India in Economic Survey has mentioned that the major impact on the value of rupee, declining value of rupee, is because of trade war. And government has done some calculation and they have calculated that because of trade war, the depreciation in rupee that has happened in recent times is around 5 to 6%, which means 5 to 6% decline in the value of rupee compared to dollar is mainly because of trade war. So trade war has played a big role in the decline in the value of rupee. So if you look carefully, suppose that Government of India is saying that the value of rupee has declined roughly around, let's say, 10%, 12% compared to dollar. So government is saying out of that 10, 12%, majority of decline has happened after the trade war was initiated by USA. Because of the US restrictive policies, the decline in, the value of rupee happened more. That is the main, claim by the Government of India in the economic survey. Now, as I told you that this economic survey talks about something unique. This economic survey has said that there is a very interesting relationship between current account deficit, rupee appreciation, depreciation, as well as the capital account. So we are going to examine the relationship between current account, the value of rupee, which means appreciation and depreciation, and capital account. This is what is being said. So let me explain to you the theory part first. So see guys, I am giving you two scenarios to explain the point. So let us look at the two scenarios. Now imagine that this is US and this is India. US or rest of the world, and this is India. Now what has happened is, suppose that India exports and India also imports, right? So because of export, import, which means current account, what does India export? Goods and services. What does India import? Goods and some services, but we export a lot of services, right? So because of our export, etc., we are able to get some dollars, and because of import, we paid dollar. But the net amount, export minus import, we were able to get this much of dollar. And this dollar is there in India, either with RBI or with banking system or with the government. This dollar is there in India, right? Now, and why did this dollar come to India? Mostly because of current account transaction, which means exports and imports of goods and services. So this is the dollar, this is the rupee. Now what happens is, suppose that for some reason, like trade war, etc., the export import of India is badly impacted and we are not able to get the dollar. Or let's say there is global volatility and vulnerability. So what has happened is, initially other countries in the world were buying India's services. Now many countries are saying we don't want to buy services. Our agriculture commodities are also not being bought. So there is a problem. So what has happened is the size of the dollar circle goes down. Why? Because we are not able to export even services a lot because of trade war and all. So what has happened? The size of this circle becomes like this. So can we say that depreciation of rupee has happened? What is the meaning of depreciation? Depreciation means the value goes down. So when there is too much rupee and less dollar, the value of the rupee goes down. It is called as depreciation, right? So what do we observe? We observe that whenever there is a current account deficit means our exports are low and our imports are more. See, imports are necessary. We have to import oil, we have to import, for example, medicine, etc. We import. But suppose exports are not happening because of trade war and other reasons. Exports are down and import is high. So we pay more dollars and we get less dollars. When we get less dollars, this is the relationship, which means current account deficit will lead to depreciation of rupee. Like, this is a very popular theory. Economic survey says that there is one more thing which also can happen. Suppose that this is happening in India, like this has happened because current account deficit is there. This is the value of rupee and this is the dollar. Now, economic survey says that if India is able to improve the confidence of foreign investors and India is able to get more FDI and more FPI, right? So, through current account, we are not getting dollars. Our dollars are less. But through capital account, suppose we are able to get more dollars. So what will happen is, in this relationship, if we inject more dollar through capital account, then the size will increase. And the size might increase like this, which means more dollars will come. And the value of the rupee will not go down. Now the value of the rupee will increase, which means rupee will appreciate. Why does rupee appreciate? Because there is too much of dollar now. So when there is more of something, its value goes down. When there is less of something, its value goes up. So now rupee will appreciate. So this is a unique situation where there is current account deficit. We are copying the same situation. See, this is current account deficit. But along with current account deficit, there is inflow of dollars. If these two things will happen, then rupee will appreciate. This is what the economic survey says. So economic survey says that we should not conclude by looking at the value of rupee that it is only because of current account, it is only because of capital account. Economic survey says if our current account is not doing well and if we can manage our capital account well, then also the value of rupee can be stabilized. That is what they have said. So let me show you the picture. So guys, the economic survey has said this, that in the year 2008, 12 and 19, if you look at the graph, 2008, 12 and 19, economic survey says that there was high current account deficit and rupee depreciation. So rupee depreciation and current account deficit happened. And the economic survey says in the year 2007, 17 and 12, so this is year 2007, this is year 2017 and this is year 2021. In these 3 years, economic survey says that there was current account deficit, but there was inflow of dollars, because of which there was appreciation of rupee. So we observe both the things. So overall, economic survey wants to say that the value of the rupee doesn't depend on current account deficit only. The value of the rupee depends on current account deficit plus the capital account together decide the value of the rupee. Then the economic survey says 2 important points, which we must know from prelims perspective. Point number 1, economic survey says that whenever there is depreciation of rupee, then India's export of merchandise, which means goods, increases. So economic survey says that whenever there is depreciation of rupee, the merchandise goods are exported more. The export of merchandise improves. And the same economic survey says that depreciation of rupee does not have much impact on export of services. Wow, that's interesting. So economic survey says that if there is depreciation of rupee, the export of goods will rise. But if there is a depreciation of rupee, economic survey says that we don't know if the value of export of services will rise too much or not. The reason being, economic survey says that countries which buy India's services, they look at the quality of India's services and the specialty of the services rather than the price, which means Indian services are not very price sensitive now. They are more quality sensitive and they are more specialty sensitive. For example, across the world, if they want, suppose India's services related to finance, like UPI, suppose. Some country says we want UPI kind of thing from you, India. Or somebody says that we need finance related advice from you, India. Even if India's finance related advice is slightly costly or digital services are slightly costly, so they say that we don't care, just that give us a specialized service of a very good quality, robust quality, and we are ready to pay the price. So economic service makes a very important point. It says that India's merchandise trade depends upon the value of rupee and dollar, which means depreciation. If rupee is depreciated, our merchandise export will increase. But economic service says if the rupee is depreciated, it does not really matter for much for services. Our service will still rise whether there is appreciation or depreciation of rupee because of quality and because of special nature of India's services. That's a very important point. Now, there is one aspect. Now we have come to the miscellaneous part of the economic survey, which talks about the international investment position. So I want to tell you a few things, bacho. So see, imagine that India has given loan to others. How do we give loan to others? By buying bonds, right? So for example, you and I have bought the bond of some US company. When we buy the bond, we give them rupee, or we deposit our currency in foreign banks, right? So we have, or suppose that we buy a property in US or Europe, etc. So this is the way the Indians are creating assets. So can Indians create asset? Yeah, we can. We can buy the shares of other countries, we can buy the bond of other countries, we can give them loan, we can buy properties, real estate, etc. This way we can create assets, right? Assets. How do we create assets? By giving loan, by buying shares, by buying properties. This way we can create assets. Now, suppose the value of the asset that we have created is 10 crore. Matlab Indians have 10 crore worth of asset outside. Now, do the foreigners also give us money? Yeah, they buy our bonds. They put money in our account. They buy properties in India. That is called our liability. Like when we take loan, that's our liability. You know what is the situation in India? The situation in India is this is an example, our asset position is 10 crore. So we have 10 crore worth of properties outside and our liability is 24 crore. What is higher, asset or liability? In India's case, our liability is higher. So whenever you do asset minus liability, whatever is the difference is called as NIIP, net international investment position. So what is the net position of India? The net position of India is not favorable because 10 minus 24. What is 10 minus 24? Minus 14 crore. So India's NIIP is minus 14, which means we are the net debtor. We don't give more money, we take more money. So NIIP is equal to asset minus liability. If it is less than 0, country it is a debtor. If it is greater than 0, country is a creditor. So India is a net debtor. So does it mean that our situation is very bad? No. Earlier our debt used to be high, abhi our debt is thoda low. So for example, earlier the debt was, let's say, minus 14. Now slowly it is becoming 13, 12, aise, right? So let us see some facts. So let's look at the list of some creditor countries in the world, that in terms of NIIP, which are the countries in the world which are net creditors, who give more money. So you can see that Germany, China, Japan, Hong Kong, these are some of the top countries in the world which are top creditors to the world. Matlab they give more money. And which are the countries in the world which are debtors? They take a lot of money from the world. US, Brazil, France, Spain, these are the countries which take in net amounts, they borrow a lot of money. Where is India? India is here. What is India's position across the world? In terms of debtor, India's rank is rank 11th. India is the 11th largest debtor in the world. Now, what about the India's situation? Is the India's situation improving or deteriorating? So, bacho, in the economic survey, they have given some findings for India for the year 2024-25. So, let us look at 2024-25 and let us see what the economic survey says. So there are two things which are given in the economic survey. The number one is called as international asset to liability ratio, which means that, for example, let's say India has got properties worth, let's say, 7 crore across the world, right? Now, suppose that the properties which others have in India is 10 crore. So we have property outside India, 7 crore, this is our asset. And what is our liability? 10 crore, which means others have property of 10 crore in India, which we have to return. So what is the asset to liability ratio of India? 70%, hai na? 7 upon 10, 70%. So this is called asset to liability ratio. So if you see the asset to liability ratio of India, and this ratio should be high, isn't it? So earlier our asset to liability ratio was 74% in the year 2024. In the year 2025, between 24 to 25, this 1 year, our asset to liability ratio increased from 74 to 77, which means earlier our liability was 100 crore, our asset was 74. Now our asset is 77.5 crore, our liability is 100 crore, which means our asset to liability is improving. Number 2, net international investment position upon GDP. GDP means suppose our national income is 100 rupees. Example, in a layman's sense, our national income is 100 rupees denominator. What is our net international investment? We know that we are debtors, we borrow more money. So earlier, it was minus 14%. So if our income is 100, net 14 rupees we had to give to others. Now it became, so in the year 2020 it was minus 14, in the year 2024 it became minus 10.1, in the year 2025 it became minus 8.7, which means our total debt, net debt is also coming down, which is a good sign, right? So if you see this in net international investment position, there are 2 ratios. The first is asset to liability position of India is improving, and our NIIP upon GDP is also coming little down, which is a good news. Now let's look at the external debt. So bacho, whenever we talk about debt of a country, there are 2 types of debt, external and internal debt. So what is the meaning of external debt? Listen to it carefully. So suppose that I am India, right? My name is India. I have borrowed 100 rupees. Out of 100 rupees, suppose that I have borrowed 30 rupees from outside India, let's say US, UK, 30 rupees, or IMF, World Bank, 30 rupees, and 70 rupees I have bought from my own people. So what is my external debt? Out of 100, my internal debt is 70, my external debt is 30. This is called as external debt. Now, let us see what is India's external debt. So first of all, we will look at India's external debt to GDP ratio. GDP means our income. Suppose our income is 100 rupees. Our external debt is 18.4 rupees, which means that whenever we earn 100 rupees, we have to give 18 rupees to others outside India. So this is our external debt to GDP ratio. Now, our global rank in terms of external debt to GDP ratio is rank 21. Look at the other countries of the world. Ye dekhiye bachcho. So this is how the other countries are placed, and this is where the India is. So India's external debt to GDP ratio is manageable. That's why our rank is 21. Now, between March 2016 and March 2025, if you look at this time period of 5 years, our external debt to GDP ratio was roughly stable in a range of around 20%, which means that if you look at the debt to GDP ratio of India, see this please. This is from around 2014 and this is September 2025. This line is the external debt to GDP ratio of India. It is roughly around, average is around 20.2%, which is a very decent number. It's not very high, right? Now, there is one interesting thing that suppose government of India has taken overall borrowed money which is equal to rupees 100. This 100 rupees is the borrowing of the government of India, right? Now, out of 100 rupees, how much is the money that we have borrowed outside India? Less than 5%. So what is 5% of 100? Rupees 5. So we have bought less than rupees 5 from outside India. And you know that whenever you borrow less from outside, you are more healthy. Whenever you borrow more from outside, you are vulnerable. So we have borrowed less from outside, which means we are more healthy. So that is one, right? So what do we observe? We observe that in external debt to GDP ratio, our average is around 20%. Currently it is 18%, which is manageable. Our rank is 21. And the government's, if you look at the government's total borrowing, you will see our external borrowing is less than 5% of government's total borrowing. Now, if you see what happened to the global external debt, which means globally, if you add the external debt of all the countries of the world, you will see that in the year 2024, yeah, If you see the data which is mentioned in the economic survey, it was 1.4% higher compared to the previous year, which means year 2024, year 2025, year 2023, we see a trend in the world that if you take all the countries of the world, they are taking more external debt, which means they are borrowing more outside their country. And the global external debt is increasing at 1.4%. Now, what is India's contribution in the global external debt? 0.69%. So, if somebody will ask you that, is India also borrowing outside? Yeah, India is. If the entire world is borrowing, let's say 100 rupees, India's contribution is rupees 0.69, matlab 70 paisa, not even 1 rupee. So, which means India's contribution in the global external debt is very low. Now, we are going to look at some ratios which are important for us. So, first of all, we saw the average external debt to GDP ratio of India in last 10 years, it's around 20%. Matlab, since last 10 years, our external debt to GDP ratio has been stable. We have not been borrowing more than our capacity. That's one good thing. Number two, the value of our external debt currently is $750 billion, right? Number three, if you look at the forex reserves of India, remember, we have $700 billion. So, if you look at the forex reserves of India upon our total external debt, what is the meaning of total external debt? Means the money that we have borrowed from outside India. So, if India has borrowed $100 billion outside, okay, we have borrowed $100 billion from outside, then our Reserve Bank of India has roughly around $85 billion, so that if required to return the money, RBI can contribute 85% of that or 86% of that, which means our forex reserve by total external debt is more than 85% or is roughly around 85%, which means whatever external debt we have, 85% of that can be easily financed by RBI. It's a good sign. Number two, I want to ask you a question. But suppose you are borrowing money, you are borrowing 100 rupees from outside India. So, I want to ask you that, what should you borrow more, for short term or long term? If you borrow for short term, you immediately have to return the money, you might be in a vulnerable situation. But if you borrow for long term purposes, then you can return the money at your own speed, at your own pace. So, what kind of borrowing should we do, short term or long term? Maximum borrowing that we should do should be long term. So, if India has borrowed 100 rupees outside India, out of 100 rupees, what is the percentage of short-term borrowing? What is the percentage of long-term borrowing? The percentage of short-term borrowing is roughly around 20%. So, if India has borrowed 100 rupees outside India, 20% of that is short-term, which means that we have to return the money in 3 months, 6 months, less than 1 year, and long-term is more than 1 year. 80% of it, the money that we have borrowed is for long-term, which means we are in a healthy position. So, what does all these things show? All these things show to us that India's external debt is healthy and balanced. Now, we are going to look at way ahead. We are going to look at some of the things that economic survey has said in terms of future policies and future roadmap that India should follow. Number one, the economic survey says that there is one thing where India has not done well, which is diversification, which means that we should diversify more in terms of product, which means that we should export more products, not only limited products. And number two, we should trade with more number of countries. So, the economic survey has given a fact that in terms of crude oil import, earlier we used to import crude oil only from limited number of countries, but now we have diversified. So, which are the countries from which we import crude oil now? Libya, Egypt, Brazil, US, Brunei, Russia, Saudi Arabia, Iraq, Venezuela, UAE, Nigeria, etc. Which means look at the long list of countries from which India is importing crude oil, which is called energy security. So, economic survey says this is a good thing. Number two, economic survey has mentioned specifically about PLI, production linked incentive scheme. And economic survey says that between the year 2020 and 24, why the year 2020? Because PLI was launched in 2020. So, economic survey says that between the year 2020 and 2024, if you look at the PLI, Asha Bacho, can you please tell me how many sectors are covered under production linked incentive scheme? 14 sectors are covered in PLI, right? Why the government of India created PLI? So that we can increase our export. We created production linked incentive scheme so that we can keep exporting more. Ultimate aim is to export. So now, I want to ask you a question. Suppose under PLI, we have kept automobile. Automobile means car, trucks, right? So many vehicles. So suppose India has manufactured this vehicle. This is a vehicle. What do you feel? Do we have all the components to make the vehicle? No. So what are we doing? We are buying inputs or raw material and we are converting them into vehicles like this, which is output. So we are getting inputs and we are converting them into output, which is the vehicle. So now I want to ask you a question. So in PLI, the economic survey says that the rate of growth of export of those items which are manufactured under PLI is 10.6%. So under PLI, we are manufacturing some items. Its export is rising at a speed of 10.6%, but under PLI, we are importing raw materials. So its rate of growth of import is 12.6%, which means we are importing lot of items under PLI in the nature of raw material and intermediate goods. We are converting them into finished products and we are exporting. Is it a bad thing? Economic survey says that currently it's not a bad thing. Why? Because the imports that we are doing is being used to promote export. But in future, the economic survey says that we should try and make sure that whatever is possible out of these things that we are importing, we should produce in India. If not, then we should buy it from others. So that is what the economic survey says. Now the economic survey says that under PLI there are 14 sectors. Out of 14 sectors, which are the sectors which are doing really well in terms of export? So IT, hardware, ACC, batteries, electronics, solar PV, specialty steel, automobile, pharma and food processing industry. These are the ones where export has increased. Which are the sectors under PLI which import a lot of raw material? Electronics, automobile, food and pharma. We import a lot of raw material. Just say for example, we import a lot of palm oil, convert it into cookies and we export the cookies. That is what we do. That is what is mentioned. Now, this is the second point, which means that economic survey says the PLI is not doing bad, but we should make sure that instead of importing too much of inputs, we should produce the inputs. This is the second point. Third point is called as economic complexity index. What is economic complexity index? Very interesting point. Economic survey says that they have done a calculation. Looking at the current capability of India and the current trend of, what India is producing, what are the inputs that we have. Economic survey did a, finding to find out that based on the current trend of India, does India have the capability to start producing sophisticated, complicated and high value items in future? This is what the economic survey was trying to find out. That does India have the capacity to produce high value items in future based on current capacity? Economic survey found that yes, if you look at this aspect of India, globally 145 countries were rated that do they have the capacity to produce sophisticated items. India's rank is 44th in the world, which means India is the 44th best country in the world in terms of the capacity to produce high value items or sophisticated items in future. That is what we have seen. And this rank of India is constant since the year 2019, which means since pre-COVID times, which means have we really increased the capacity to produce sophisticated and high value items? Economic survey itself says, no, we have not, which means that we need to do more. So these are some of the points that economic survey says. There is another thing which economic survey says. This is a very important and crucial point. And I believe that this point related to governance is very important. I'll show you that point. So I'm going to take one example from my side, which is slightly different from the economic survey to make it easy. So imagine that this is Panama Island and this is India. Now in India, there is a company called Apple. Let us see what Apple is doing. Apple is manufacturing, let's say it's iPhones. Okay. And in this year, which means 25-26, this is almost the end of Feb. And Apple is calculating that what will be its profit for this last 1 year, because on the profit it has to pay tax. So Apple has calculated that its profit is going to be somewhere around rupees 100 crore this year. So Apple is going to make 100 crore profit, okay? Now, so Apple says that if I show 100 crore rupees profit in India, which is the expected profit, I will have to pay, example, I'll have to pay a tax of, let's say 20%, which means 20 crores. So what does Apple do? Apple tells the government of India that in my phone, which is iPhone, the shape of the iPhone, which is the design, is not mine. I purchased the design from another company which is in Panama called as Apple Panama. Government of India says, but it's your company. So Apple India says, no. We are Apple India, this is Apple Panama. It's our sister concern. and we are buying the design from them. So government says, and what is the price of the design? So Apple says the price of the design is 99 crore. So what does Apple do? Apple transfers 99 crore to Panama. So ideally the profit of Apple in India should have been 100 crore, but now it will be 100 minus 99 because 99 becomes cost. What is the profit? 1 crore. So how much tax will Apple pay in India? 20% of 1 crore, 20 lakhs. And what was ideally the tax? 20 crore. Why does the Apple do that? Because in Panama, the tax rates are either very low or close to zero. So on this 99 crore, Apple will hardly pay 1 or 2 lakh rupees tax in Panama, remaining tax free. This is how the taxes are saved. This concept is called as transfer pricing. This price 99 crore has been created in such a way that it transfers the entire profit from Apple India to Apple Panama. This concept is transfer pricing. So when two related companies do transfer pricing, they transfer the huge amount of profit from a country like India to other countries by exaggerating the price. They exaggerated the price of design to 99 crore. Now, this is point number one. Point number two. Suppose that there is a company in India called Samsung. Right? Now, what does Samsung do? Samsung manufactures mobile phone in India, but the camera that Samsung uses, it imports from its own country, which is South Korea. So whenever you import a component in India, you will have to pay custom duties, right? Custom duties will have to be paid. So what does Samsung do? When it imports the camera, it suppresses the price of the camera in India so that it doesn't have to pay custom duties. So when it imports the camera from South Korea, if the price of camera ideally is 100 rupees, Samsung says that the price of the camera is not 100, the price of the camera is 10 rupees only. Because suppose custom duties is 10%. If they declare the price of camera to be 100 rupees, they will have to pay 10 rupees as custom duties. But if they declare the price to be 10 rupees only, then they have to pay only 1 rupees as custom duties. So different companies which are operating in India, they have a tendency to increase the price during transfer pricing and suppress the price during custom duties. Now, Government of India has different departments which takes care of transfer pricing. Who takes care of transfer pricing? The Income Tax Department. Who takes care of custom duties? The Custom Duties Department. These two departments must coordinate in India so that if a company is doing both, or if the companies are doing these things in India, these two departments should talk to each other so that a company like Samsung and a company like Apple, they need not go to various ministries and departments. They can go to only one department or ministry in India and they can sort out their problems. So we should create a system in India where the issues related to transfer pricing and custom duty should be handled within the same framework. Ministries departments could be different, but there should be a coordinating body where these issues should be handled so that there is no delay in export, import and production. These things are suggested in the economic survey. So this completes our chapter on external sector and balance of payment, and now we go to the chapter on services. So guys, this is chapter number 7, which talks about services from stability to new frontiers. Let us see the details of this. Now, we have divided this chapter into 3 parts. The first part talks about fact sheet, which is what is the importance of service in terms of GDP, employment and other areas. Number 2, what are the other performance indicators like PMI services, Purchasing Managers Index services. Then we talk about the basic service trend across the world and in India. Then we also talk about something really specific, that before the pandemic and after the pandemic, which is the COVID pandemic, what has been the change in the nature of foreign direct investment in services in the world and in India. So these are mostly trend related. The second part talks about various, types of aspects that we need to look into service sector. For example, when you look at the recent trend in services, we want to know that what is driving the service sector in India, which means that which part of services are actually contributing more and which are contributing little less, where there is more potential. Number 3, that which are the states of India where you see more services contribution in their growth. Then we also want to look at service sector from the perspective of rural and urban areas. We also want to see that what is the participation of women in services in India. Now, there is one interesting aspect which is given in the economic survey, which says services act as buffer for uncertainty. So whenever there is global uncertainty like the tariff barrier, trade barrier, etc. So what is the role of service sector in that? And then there is a concept called as servicification, which was discussed in the last year's economic survey also and this year's economic survey as well. So we'll look at servicification. Then we'll also look at some of the subsectors of services like travel and tourism, IT and IT enabled services, transportation, telecom, real estate, right? And one of the government of India's favorite part of services, which is orange economy. So we are going to look into that. So first of all, the service sector fact sheet. Now, what is the contribution of service sector in India's GDP, bacho? The contribution of service sector in India's GDP is roughly around 53.6%, which means more than 50% of India's GDP comes from service sector. Now, what is the contribution of service sector in employment? Its contribution, as per the economic survey of this year, the contribution of service sector in employment is around 30%. Now, there are three sectors in India: agriculture, industry, and services. So, what is the contribution of service sector in employment? 30%. And according to economic survey, the contribution of industries in employment is around 25%. It could be 25, it could be 26. And the contribution of agriculture in employment is around 45%. So now there is something interesting which has been mentioned. Economic survey says service sector is contributing more than industries in employment overall, in a generic sense. Now, economic survey also mentions that if you take industries, bacho, in industries there is manufacturing, there is construction, then there is electricity, gas, water supply, etc. So if you look at all these things, the contribution of manufacturing here is roughly around 11 to 12%. The contribution of construction is 11 to 12%. So if you take roughly around, let's say 11%, so manufacturing contributes 11% to our employment. Construction also contributes 11%. So total they contribute 22% in India's employment. So if total contribution of industries in employment is 25%, manufacturing and construction, these two together only contribute 22%, which is that remaining 3% or 2.5% comes from electricity, gas and water supply. So what is the contribution of services in employment? 30%. What is the contribution of manufacturing and construction? 11 to 12%, 11 to 12%, which means service sector is creating more employment instead of manufacturing and construction in India. Now, this economic survey says that this is something that we need to look into carefully. Now, I want to ask you a question. Which service do you think is creating more employment? The service sector like artificial intelligence, etc., or the service sector like health, education, which is tourism, which is more labor intensive? The labor intensive, yes, the low end services. The high end services are mostly automated. They don't create too much employment. The low end services like transportation, logistics, etc., they create more employment. Okay, now there is one thing interesting which is mentioned in the economic survey which talks about employment elasticity. What is the meaning? See, if a particular sector grows, we want to see that what is its capacity to generate employment as the sector grows. So if the income in the service sector increases or service sector becomes bigger, does it have the capacity to generate more employment? That is called as employment elasticity. So if you look at the employment elasticity of services between the year 2011 to 2024, like average employment elasticity of services has been 0.43. What is the employment elasticity of agriculture? 0.41, manufacturing 0.22, construction 0.60. Now look carefully, you will find that the employment elasticity of construction is the highest in the recent times, followed by employment elasticity of services, which means services are generating, they have the capacity to generate more employment. That is followed by agriculture, then manufacturing and construction. That is followed by, agriculture and manufacturing. This is worrisome because the capacity of manufacturing to generate employment is less compared to services. Economic survey has mentioned that this is something which we need to correct. But services nevertheless are contributing a lot. Now, if you look at India's services, the fact sheet, Indian service sector is the 7th largest service exporter in the world. So, Indian services are the 7th largest service exporter in the world. So, our global rank in terms of export has improved mainly because of services. Now, India's share in global services, because our service sector is the 7th largest exporter in the world. So, we are interested in knowing that what is the contribution of India's service sector in the global service trade. In 2005, Indian service contributed 2% to the global service trade. In 2024, Indian service contributed 4.3% to the global service trade. India is also seeing a lot of FDI coming to the service sector. So, if you look at all the sectors of India, agriculture, industry and services, service sector is the largest recipient of FDI in India. So, these are the basic facts related to services. Now, Bacho, there is something interesting which is called as Purchasing Managers Index Services. What is it? I'll give an example to you. So, what happens is there is this organization called as HSBC IHS Market. What they do is they send a questionnaire to the managers of various companies who are into service sector. So suppose that you are a manager of the service sector. So as a they select some managers, let's say 500, 600 managers, and they send them questionnaire. What are the questions that are mentioned in that sheet, in that paper? So, and it is done on monthly basis. So the questions are related to 5 important areas. The first question that is there is, and this question has the highest weight, that are you expecting new orders? So I send you a questionnaire where I'm asking you, are you expecting new orders? Number 2, that what about the prospects related to production and output? Are you planning to increase? Number 3, are you going to give employment to somebody new? What is the supplier's expected delivery time of the services that you are creating? And are you expecting an increase in inventory? Inventory means raw materials, semi-finished goods, etc., finished goods in your, which you want to sell. So these are the things, and this in the bracket you can see the importance of these parameters. So these 5 different types of questions are asked to the managers, answers are compiled, and then a score is given based on these 5, because this 5 shows the expectation that the manager has for the business. If the score, combined score of all these questions is greater than 50, then we believe that there is optimism in the economy and the economy is growing, because the manager has positive outlook about the economy. And when do managers have positive outlook? When they see some things happening around them, which gives them more orders, which increases the business. So what have we observed in India? We have observed in India that, in the year 2024 and 2025, the value of PMI. What is PMI? This combined score is called PMI. The value of PMI services has been greater than 50. So that's a sign that we have been doing well. Now, there are 2 important things which are mentioned in the economic survey related to the world and India. This is very interesting. The economic survey compares that what is the share of services in GDP in the pre-COVID time and the year 2024. So economic survey says that service sector has been contributing a lot in GDP. So economic survey says that they want to compare that what was the contribution of service sector in the GDP before COVID and after COVID. So before COVID, they are taking the year 2015 to 2019. And after COVID, they are comparing with 2024, because they want to see that before COVID, what was the level of contribution of services in GDP, and in 2024, have we been able to achieve that pre-COVID level, right? So let's look for India first. If you look at India, in the pre-COVID level, the contribution of service sector in GDP was 48.3%. In 2024, it became 49.9%. Abhi to it is more than 50%, as we saw. Which means that has our contribution of service sector in the GDP been able to reach the pre-COVID level? Yeah, it has been able to cross it. So we have done well. Now let's see across the world. Across the world also we saw that the contribution of services in the global GDP was 65% before COVID, and in 2024 it is 66.3%. But the world also recovery has happened. But where is the recovery the strongest? In China, the recovery has been really good. Service sector has bounced back. UK also it has been good, India also good, European Union, US thoda low, but there also recovery has happened. This is in terms of contribution in GDP. Now, let us look at rate of growth of services before COVID and after COVID in the year 2024. So if you look at China, and if you see, then in the pre-COVID phase, the rate of growth of service sector was 8% on an average, and in 2024 it's 5%. Which means that overall there is a loss of 3%. Let's look at India. Pre-COVID it was 7.6%. In 2024 it is 7.2%. Which means that there is a loss in the rate of growth of services in India also, but the loss is roughly around 0.4%. But in China the loss is 3%, which means yes, the Chinese services were growing faster than India before COVID, but after COVID India has taken over. So these are some of the good things that are mentioned. Now, FDI in services, foreign direct investment. But if you look at the world global scenario, you will see that economic survey says that we can divide service sector into some important areas. For example, energy, gas, information and communication, construction, transportation, and others. In the pre-COVID time, if $100 FDI was coming in services, it was distributed evenly in a balanced manner between all the services. You see, energy 26%, others 13, others 23, transportation 10, construction 20. So it was more balanced. But after COVID, what has happened is more FDI is coming in energy and more FDI is coming in communication, as you can see. See, which means that after COVID, the FDI is more concentrated towards energy, gas, and communication side. So there is a change in the pattern of FDI globally. Now let's look at the Indian scenario. So bachcho, suppose that this is India, right? In India, total $100 are coming in the form of FDI. Out of $100, in the pre-COVID time, how much money was going to service sector? 77.7%. After COVID, how much is going to service sector out of total FDI of India? More than 80%. So if $100 are coming to India in the form of FDI, 80% is going to services, which is huge. Now, within services also, which are the services of India where there is too much of FDI going, and how is the FDI distribution in India in services? So suppose that $100 FDI is going in services. $100 in services. Out of $100, 25% goes in information and communication, professional services 23.8%, finance and insurance 14%, energy and gas 12%, but globally we saw energy and gas dominates, trading 12% and others 11 to 12%. This is how the distribution, which means that in India, majority of FDI in services is coming in either digital domain, which is information and communication, or in the professional services, which is knowledge domain, which means in India, the digital and the knowledge kind of services are more important. Now, let us look at the drivers of services. Which are those services which are driving the overall service sector in India? So, what is the first thing that we saw? The first thing that we saw was that the contribution of services in India's GDP is increasing over time. So, we can see in the pre-COVID phase, services were contributing 51.3% in India's GDP. Then, in the post-COVID phase, 52%, 52.6%, and currently H1 FY26 means we are talking about the first half of the year 2025. So, for example, let's say that we start from April. So, April, May, June, July, August, September, right? So, we are talking about that phase. We can divide 12 months into 6 months. So, the first 6 months is called H1. So, 2025. So, we see that the contribution of services in India's GDP is 53.6% and it is increasing consistently. But let us see that within services, which sectors are contributing more. So, bacho, let us see this. Number one, let us look at finance, real estate and professional services. So, see, what is the contribution of finance, real estate and professional services? In this 53.6%, roughly 24% is contributed by finance and professional services. They are the biggest contributor. And see, their contribution has increased also. So, they are the main drivers. At number 2, we can see that 14.3%, which means that we are talking about public administration, defense and others. That is also increasing and significant contribution. Number 3, trade, hotel, transport, communication. It is contributing 15%, no doubt about it. But see, the contribution is coming down, which means that it's going down, right? So, what are the key drivers? The first key driver is finance, number A. The second key driver is public administration, defense and other services, and the third key driver, which is a thing of worry, is transport, hotel, etc. But why transport, hotel have not been able to rebound? Because transport, hotel and all these things, they are related to contact, which means physical contact. For these services, like how do you promote tourism? Physically, foreigners have to come to India. But you understand that physical transportation in the global chaotic situation is not that great. That's the reason that this service is not contributing as per expectation. Its contribution is going little down. But if you have to divide Indian services into key drivers, then finance is number 1, public administration, defense number 2, hotel industry, logistic is number 3. Now, let's look at some of the states in India and let us look at the service sector there. See. So, according to economic survey, Karnataka, Maharashtra, Tamil Nadu and Telangana, they contribute 40% of India's service output. So, if India produces services worth $100 billion, 40 billion comes from these states only, Karnataka, Maharashtra, Tamil Nadu and Telangana. And which are the services they promote a lot? They mostly promote services related to IT and finance, which means high productive services. Okay. Now let's look at Bihar. There are a few interesting things which are given in the economic survey. So for example, let's talk about Bihar. So the per capita income of Bihar is low, right? Still, if you look at the total income of Bihar, suppose that yearly income generated in Bihar as a income of the state is 100 rupees, roughly 58.7 comes from services. Which are some of the services which are growing in Bihar? Educational services, telemedicine, health related services, etc., transportation services. These are growing in Bihar. Storage services. So Bihar economy is also getting almost 58-59% of its income from service sector. Look at Kerala. 64.3% of the income of Kerala comes from services, right? So you have two extreme examples. One is a state with high per capita income, its income is coming from services. A state with low per capita income coming from services. Let's look at Odisha and Assam. 35% of their income comes from services, but earlier it used to be 37%, now it is 35%. So the contribution of services in the income of Odisha and Assam is going little down. Now, let's look at rural-urban scenario. Okay, so here we are looking at Q1 and Q2 of 2025, which means April, May, June, July, August, September. We are looking at 6 months time. Now, in 2025, 62% of the people in the urban India work in services. So if 100 people are working in urban area, 62 are working in services, and 20% of the rural people are working in services. Similarly, if you look at women, so in urban area, 60% of the women work in services. So for example, I am in Delhi. Example, there are 100 women who are working. 60% of them are working in services. And in rural India, 10.5% of the women work in services. So if you look carefully, you will see that in urban India, service is dominant, and women in urban India mostly work in services. Now, as I told you that there is one interesting thing which is mentioned in the economic survey this year, that service sector can act as a cushion or a buffer for global uncertainty. What are the two things that we can export? Goods and services. But we know that when there is global uncertainty, transportation of goods becomes difficult. So economic survey says that it is at this time that service comes to our help. Example, economic survey says that if you look at a ratio which is service export upon GDP. So bachcho, suppose that our GDP or national income is 100 rupees. Matlab this is the income that India is generating every year. So economic survey says that before pandemic, which means the year 2015, 16, 17, 18, 19, if 100 rupees is our GDP, how much money we were getting through export of services? 7.4 rupees. Which means that the contribution of service export in our GDP in the pre-pandemic level was roughly around 7.4%. Now, if you look at the year 2022 to 24, which is after COVID, the contribution of service export to our GDP increased to 9.7%. And in 2025 H1, first half, the contribution increased to 10%, which means that if 100 rupees is the GDP, the contribution of service export became 10. So 100 is the denominator, 10 is the numerator. Now, rate of growth of service exports. Is our service export rising at a fast speed? Let us check. So the average rate of growth of services per year between 2015 to 19, before COVID, was 7.6%, which means if India is exporting service worth 100 crore this year, next year it became 107.6. That is the service rate of growth. Now, what is the rate of growth of service export between the year 2022 to 24? 14%, which means that pre-COVID, if you compare with post-COVID, the rate of growth of service export doubled, right? Roughly around doubled. So which means that earlier 7%, now around 14%. If you look at FY26, April to November, which means 2025, April to November, the rate of growth of service export is 8%. But we know that it already reached 14% between 22 to 24. Now it has become 8%. Why? Because of trade war and the global chaos. So yes, it has also affected us, but even then it is around 8%, which is a very good number. So that, because if you look at the rate of growth of export of merchandise in India, it is hardly 2.5%. But rate of growth of services even in a difficult time is 8%. That's why it is said that even in difficult times, services act as our savior. And this is what this whole diagram says. So this diagram says, if you look carefully, that service export to GDP ratio on an average earlier was 7.4. Now the average has become 9.7. Now, there is a concept bachcho called as servicification. So let me tell you what is the meaning of servicification. The meaning of servicification is, example, you see these days, you see automobiles being manufactured across the world, including India. What do you find in automobiles now? Lot of electronic components are being used currently, right? Now, I can give an example to you. So these days, what happens is whenever there is a problem in the automobile, you take it to the service center. They will connect it to computers and they will do the diagnostic that what is the problem in the vehicle and they will try to fix it, which means literally the hardware these days, hardware means things that you can touch and feel, is nothing without the software or the services which are present inside them. For example, I'm wearing a digital watch. What is the meaning of the hardware? Nothing. In this hardware, there is operating system, there are apps which I'm using. If you remove the apps, etc., this hardware becomes useless, piece of metal. So these days what is happening is there is an increasing integration between manufacturing and services. Without services, manufacturing cannot survive. I produce goods, but to transport them, I need transportation services. I am manufacturing laptops, I am manufacturing mobile phone, but there is an operating system inside them. And I have to give to the customer the assurance that if your phone is not working or laptop is not working, I'll take care of the software also, hardware also. So if India wants to position itself in the global market as a great manufacturer, we have to make sure that we keep on becoming strong in services also. This integration of manufacturing and services is called as servicification. But what is the challenge in servicification? It's very costly. So for example, suppose that tomorrow you decide to manufacture a mobile phone in India through your innovation. You also need to develop an operating system for that. It's very costly, number one. Number two, labor force is very difficult to get. So you need skilled labor force and the process is very costly, complex and labor force is required. So these are the three challenges in servicification. But if India wants to become global powerhouse in manufacturing, currently we have to integrate services inside that. That is called servicification. And by the way, if you want to read a good research on servicification, you can read a research by Professor Goldar, who talked about servicification in India. So now, bacho, we are going to look at various subsectors under services. So, for example, how is the travel and tourism doing? How is transportation doing? All these things we are going to examine just to see the performance of various services in India. So let's start with tourism. So in tourism, we can see that some fact sheets. So travel and tourism. What is the share of travel and tourism in India's GDP? Roughly around 5.2%. Very important, okay? Now, what is the employment created in the travel and tourism? 8.5 crore. That's a good amount of employment. And what is the contribution of travel and tourism in terms of percentage of employment in India? Roughly around 14%. It was 13.3%, so roughly around 14. And how many people are working in travel and tourism? Roughly around 8.5 crore. Now, do we earn a lot of foreign currency through travel and tourism? Yeah, through the arrival of foreign tourists. So in 2024, we earned $34 billion. In India, what is, the scope or what are one or two things in tourism in which we are doing really well? One is medical tourism. We are doing really well. And in the foreign tourist arrival, because of the global chaos, the foreign tourist arrival is coming little down in India. Now, let us look at some of the focus areas of the government which is mentioned in the economic survey related to tourism. Number one is government wants to promote niche tourism. So, for example, bacho, you can see that if you talk about any vacation like weekend, Holi, Diwali, Christmas, etc. So, almost literally 99% of the Delhi you will find in Shimla, Himachal, Uttarakhand, Mussoorie and all those places, Leh, Ladakh. Why? Because now literally everybody wants to go on hiking. For example, the mountain trails, the hilly areas, the river trail. We all want to go camping, hiking. So Government of India says, why not promote it more? So this is called niche tourism, very specific and kind of focused tourism. Number two, marinas. So what are marinas, guys? See, as you can see that there is a harbor which has been created. It's an artificial harbor. Why has this harbor been created? To promote both shipping as well as recreational activities. So these are called marinas. So marinas are these harbors which are created specially to promote recreational activities. So Government of India says that India also needs more marinas. Now, there are some schemes which the government of India is running to promote tourism, which have been given specific mention in the economic survey. Swadesh Darshan 2.0, Prasad, Dekho Apna Desh, and Incredible India. Let us look at all these schemes and what is important from these schemes. So, for example, Ministry of Tourism is promoting these schemes. So, these are the central sector schemes. As you can see, first is Swadesh Darshan. What is Swadesh Darshan? See. So, basically, this scheme was launched in 2014. The first phase of the scheme was between 2014 and 2022, and the second phase was launched in 2023. So, currently, Swadesh Darshan is called as Swadesh Darshan 2.0. So, let's see the first phase of the scheme. In the first phase of the scheme was promoting theme-based tourism. So, for example, bacho, if you go to Gaya in Bihar, you will find a Buddhist circuit. If you go to Sarnath in UP, you will find a Buddhist circuit. So, Government of India was saying that in the first stage of Swadesh Darshan, the government is not focused upon place, the government is focused upon theme. So, Buddhist circuit, wherever there is Buddhist circuit, it will be promoted. Similarly, coastal areas, similarly desert areas, the government said we are going to promote all these things, right? So, this is called theme based. But now, the government of India is saying that we want to promote tourism in the holistic sense. We also want to promote employment and economic growth. So, yes, in stage 1, we started the promotion of themes, which is continuing even today. But now we have also started to promote places. So, for example, the government is saying that now we will promote destination tourism like Prayagraj, Ajanta, Ellora, right? So, these are destinations. So, under Swadesh Darshan scheme, the first phase was promoting themes, the second phase is promoting destinations. This can come in the prelims. What is Prasad scheme? In Prasad scheme, what the government does is government identifies some pilgrimage destination, right? Places of religious importance. And there, the government of India says that we will integrate local art, craft, and provide infrastructure for the development of the whole region where pilgrimage can be done. So, this is going to be an integration of tourism plus, the religious sentiments and the culture of India. So, that is called as Prasad. The next scheme is Dekho Apna Desh. As the name says, here the government is promoting the Indian citizens to explore Indian culture, nature and heritage. Here government is promoting two things, the destinations. For example, the government will say, let's go to Varanasi, and government will also promote the product. If there is any unique product which is being created there, that is also promoted by the government of India. So, Dekho Apna Desh. Then there is Incredible India. See, Incredible India was launched in 2002, and the first phase of Incredible India 1.0 was there till the year 2016. In 2017, we started Incredible India 2.0. What is Incredible India 1.0? So, in Incredible India 1.0, the government was doing general promotion of tourism in India. Like government used to release videos and advertisement that come to India, experience the hospitality, etc. But in the second phase, the government is becoming very specific. That government is saying that we will promote India as a destination for spiritual awakening, for medical tourism, for overall wellness. So, we are taking one particular aspect of India called as soft power, and we are trying to market it. Earlier it was generic, now it has become more specific. We are going to see the second subsector of services, which is IT and ITES, IT and IT enabled services. Now look carefully, bacho. There is something called as Global Capability Center. I'll give an example to you. So suppose that I am the CEO of Microsoft. Microsoft is a US based company. I know that India has a young population which is highly interested in computers, and the labor force is not very costly also. And India's education system is also promoting a lot of service and skill related activities. So if I'm Microsoft, what I'll do is I have a research center in US, but it's very costly. So I'll open a research center in India. In that research center, I will hire the local talent, and I'll try to pass on some of my research related activities to India, and India will develop new products and new softwares from me. These softwares and products then Microsoft is going to use across the world. So those centers of excellence or research which these global companies are creating in India are called as GCCs, Global Capability Centers. Now let us see that how India is doing in Global Capability Centers, GCC. So if you look at the revenue generated by GCC in India in the year 2018 and 2023, if you compare, earlier it was $40.4 billion, now it is $64 $0.6 billion. So there is a growth of around 10%. Similarly, if you look at the employment generated by GCC, earlier 14 lakh, now 19 lakh. So that is also increasing by 6.3%. If you look at the number of GCCs, earlier there were 1430, now there are 1700. So number of GCCs have also increased in India. However, the economic survey mentions that there are 2-3 problems. Economic survey says that around 20% of the world data, like 20% of the world data is generated in India, because we have a huge population and we promote so many sectors like agriculture, industry and services. So 20% of the world data is generated in India, whereas India has only 3% of global data centers. And government is saying that the data which is generated in India should remain in India. But how will it remain in India if you don't have servers, if you don't have data centers? That's why in the latest AI summit which happened in Delhi, the government of India had invited a lot of data centers and data related companies so that they can open their offices in India. And government told them that we'll give them tax holiday and tax free existence in India till the year 2047 also, under certain conditions. So this is one thing which is not good in India. Number two, if you look at the startups of India, the startups which are doing cutting edge technology and research. So how many startups are registered in India? Roughly around 1.97 lakhs, which is around 2 lakhs. Hardly 10% of those startups are into deep tech, into something really substantial in terms of technology. Hardly 10%, which is 20,000 startups. That is the second negative aspect. One of the good things about India is when a ranking is done across the world about cyber security resilience, India comes right at top. So amongst the top 10 countries of the world, India's name is there, that India is resilient in terms of cyber attacks. So that is one positive thing. That is what should attract the data centers to India. Now, what should India do to promote more data centers, to promote more GCCs, global capability centers, and to create more deep tech in India? See, guys, there is one country in the world which has done specifically well in terms of cutting edge technology, research, and development in the field of services. And the name of that country is Singapore. You know what Singapore did? I'll give an example. I am the government of Singapore. I knew that my companies, for example, if they start to do original research and development, they will take 20 years or 10 years. I don't want to be 10 years behind. My companies are good, but they need time and money. So what will I do? I will tell my companies to do collaboration with foreign companies who are working in the same domain. I will ask them to create partnerships. I will invite foreign companies and tell them to create joint ventures. So through collaboration, through providing a unique platform where foreign and their own companies can work together, joint ventures, etc., they try to create a great service sector which is backed by amazing kind of research and development facilities. Similar model can be used in India, through collaboration, through contacts, through providing a platform where the foreign companies and the Indian companies can interact, and by creating a coherent policy so that there is a clarity. If a foreign company is coming to India, they should know what India is going to offer. So we can actually follow the Singapore model by Indianizing the model actually in a more democratic manner. So this is something which is mentioned in the economic survey. Now let's talk about transportation. You know that transportation is called as the backbone of the economy. Without transportation, agriculture, industry and services cannot function. So the economic survey says that the contribution of transportation in India's gross value added is 4.5%, right? So roughly around 4.5% is the contribution in terms of, let's say, the value that we generate in India. So let's say we are talking about national income in a sense. So around 4.55% is the contribution of transportation. Now, there is one thing which is mentioned in the economic survey called as port turnaround time. In terms of shipping, when a ship comes to the port, so what is the time the ship takes so that it can again take a new journey? So suppose a ship is coming through, America by carrying some goods to us, or Russia, it's carrying oil to us. How much time the ship needs to spend in India before it takes the return journey? Earlier it used to be 43 hours, now it is 30 hours. So the ship turnaround time has reduced. What has happened in aviation sector? In aviation sector, the number of passengers who are using has increased, cargo has increased. We are transporting more people and goods. But here I would like to mention that government needs to create better policies for aviation. Government needs to have more checks and balances to check the quality of the machines, the training of the pilots and the life of the people, because we have seen so many accidents recently in the field of aviation. So just looking at numbers is not important here. Quality of service, regulation and the audits are very crucial here. Now, there is something interesting which is mentioned about railways in this year's economic survey and budget. So I have mixed the economic survey and budget here. So see, railway freight services. There is one dream of the government of India, that our transportation system should not depend only on roads, but it should also be shifted to railways and waterways. So what has the government of India done? So in 2025, the railway freight means movement of goods, it crossed 1 billion turnover in 2025. So finally we crossed the magical figure of 1 billion through railway transportation of goods. This much value or this much revenue was generated by railway by giving transportation service. It's a landmark, it's a good thing. The government of India has also developed dedicated freight corridors, and there is a second concept which the government is developing, which is called as truck on train service. So first let me explain to you dedicated freight corridor. See, so this is India. We know that on the same railway track, this is a railway track, the train carrying goods and the train carrying passenger both move. This creates delays, because if a train is moving, another train has to wait. It also damages the railway track. So what has the government done? The government is making efforts to create freight corridor. Freight corridor means those railway lines where only the goods train will move. So this is called as Eastern Dedicated Freight Corridor. This is called as Western Dedicated Freight Corridor. This has been developed as a collaboration between World Bank and India, and this has been developed as a collaboration between Japan and India. And what has happened because of these two dedicated freight corridor? Dedicated freight corridor is corridor where only the goods are moving, the trains are moving. So what is so good about it? The good thing about this is that around 70% of the freight that was moving in this area now is moving through these corridors. So what has happened? Because of this, there are many railway tracks which have become free for passenger train movement now. It's a good thing. So this is almost successful, the freight corridor. Now in this year's budget, the government has made another freight corridor proposal which is going to connect Dankuni with Surat, West Bengal with Gujarat. This is the new proposed freight corridor. And in future, another freight corridor will be made like these also, where the dedicated trains will go, which will carry goods. So this is the first thing. Now second is called truck on train service. Look at this please. So what happens is, for example, there is a truck which has to move from Delhi to Gurgaon. So what will happen is, if the truck moves through road, it's going to take a lot of time. So what is the government doing is, government is already making a freight corridor between Mumbai to Delhi where trains are moving. So the truck will be put on the trains in Mumbai. This train will come to Delhi and these trucks will be taken out of the train in Delhi, and from Delhi the truck will travel to Gurgaon through road. So Mumbai to Delhi, the truck will be put on the trains. From Delhi to Gurgaon, the truck will move through road. So see, what are we doing? We are putting trucks on the train. That is why the name of this scheme is truck on train service. Currently, this truck on train service is being used in the Western Dedicated Freight Corridor, where we put trucks on the train for long distance, and for short distance, the trucks moves on the road. This is the new concept. Now, there is another thing which we are doing in India. This is called as high-speed rail corridor. So what is India constructing? India is constructing 7 high-speed rail corridors. See, 7 high-speed rail corridors. Like for example, Delhi to Varanasi, Varanasi to Siliguri, then Mumbai, Pune, Hyderabad, Chennai and Bengaluru, right? Now, and we have already seen that we are already creating a dedicated freight corridor from Dankuni to Surat, and these 7 high-speed corridors are also being made, right? So what is the government of India doing this year? This year, the government of India has said that they are going to construct roughly 4,000 kilometer railway track in all these new tracks that they are laying. And the government has said that they are going to spend 16 lakh crore rupees in creating various corridors in India. So this is for transportation. Let's look at tele-density. So in tele-density, it means that out of 100 people, how many people are using telephone? Earlier 75% people, which is out of 100 people, 75 people were using telephone. Now the number has increased to 86.8%. Out of 100 people, 86.8. And mind you that there is a fast growth in the number of people using telephone in the rural area compared to urban India. Rural India is seeing more growth. Now, in real estate, what is the contribution of real estate in India's gross value added? 7%. This is the contribution of real estate in India's GVA, gross value added, 7%. It's a very significant contribution. There is one thing specifically which is mentioned in the economic survey, that over a period of time, people have been spending more money in real estate, buying land, buying buildings, etc. They are investing more money in the real estate and they consider it as a form of savings. So, economic survey has shown this graph that this is how people have invested money in the real estate and they take it as physical savings, physical assets, right? So, it has increased, and see the number of house sales. If you look at the average, see this is the average number of house sales here in the year 21, 22, 23, and look at 25, 26. The sale of house has also increased, right? So, now let us look at what is the meaning of orange economy. Right. So, do you know recently that the French president agreed to give interview in a podcast to Raj Shamani, and it became a big news that the French president is not interested in Indian mainstream media channels, but he is interested in giving interview to podcasts, and that too by individual podcasters who have become so big, right? So, that is a part of orange economy. What's an orange economy? See, in orange economy, what happens is, for example, the focus is not physical goods. I'm taking interview, for example. That's not something which is like a pen which I'm manufacturing. I'm not manufacturing laptop or computers. It's something very special and very specific. Why? Because it is related to creativity. It is related to ideas, knowledge, artistic expressions. So, for example, recently you saw that Arijit Singh said that he's not going to sing for Bollywood, right? So, but remember, whenever Arijit Singh used to perform, either in Delhi, Mumbai, Bangalore, Kolkata, wherever he used to give stage shows, so lakhs and lakhs of people used to go. There are people who sell tickets, there are people who make seating arrangements, transportation, hotels, people selling food, beverages, everybody makes income. So, that is also called as orange economy. Why? Because singer singing his song, etc., is related to artistic expression. Similarly, suppose somebody is organizing a poetry show, that is also artistic expression. So, anything which generates value, income, through ideas, knowledge, artistic expression and cultural content rather than from physical goods is a part of orange economy. So, these days there are many influencers, financial influencers, entertainment influencers, food influencers. They are all part of orange economy, or they are also called as creative economy or creators economy. Now, economic survey says that according to UN, the UNCTAD report, out of the entire global GDP, okay, so if the global GDP is 100 rupees, total world is creating an income of 100 rupees. So, UNCTAD says 0.5 to 0.7% of the income is coming from creative economy. So, creative economy is slowly growing. Now, economic survey of India, it mentions something very specific. It talks about something called as concert economy. Economic survey says that one of those parts of orange economy which has huge potential to generate employment, income and economic growth is concert economy. Concerts related to songs, concert related to performances, dance, music. So, it is saying that it leads to direct and indirect employment. The artists who perform directly, they get money, and people who depend on them, they indirectly make income. So, the government of India is saying that we should create better policies, faster clearances, we should not torture the people who are artists, etc. We should make their life easy. This is mentioned in the economic survey related to orange economy. Now, so the economic survey talks about some problems that Indian service sector is facing, and that is what we have to discuss. See, the economic survey says that Indian service sector is growing very fast. The conventional services like health education, like digital economy, right, professional services, finance services, we have seen that defense services, everything is growing very fast. But along with those, is the skill development happening to match the requirement of services? That's a big question that the economic survey is asking. So, economic survey is saying that the requirement of service and the service sector is growing, but the people who have the right skill to support the services, so do we have that? Yes, population wise we have, but skill wise there is a gap. This is the demand of people with skill and this is the supply. So, if we want our service sector to boom out, then we need to train our workers so that skill should not become a hurdle in services. So, that completes our service sector from UPSC perspective. Now, we are going to do artificial intelligence as the final part. So now guys, we are going to the next chapter, which is chapter number 14, whose title is Evolution of AI Ecosystem in India, the Way Forward. Now, let me give you some facts related to AI, which was discussed by the Government of India last year and this year. See, something very interesting. In the Economic Survey 2024-25, which is last year, the Government of India was mentioning in the Economic Survey that, India should be ready for AI. When AI comes, what should we do? These were the things that were mentioned in the Economic Survey. Now, this year in the Economic Survey, the Government of India is saying AI is already there. Now, we have to make quick adjustments, and these are the policies that we should start with. So, there is a difference. Earlier, we were saying when it comes, what should we do? Now, it has already come. Now, we are saying that it has already come. This is how we should actually start behaving now. So, it's the same thing, but you remember, almost decades back, there was this debate that is globalization good or bad. Now, there is no such debate because globalization is a reality. It's already there. So, asking a question whether globalization is good or bad is not going to solve the purpose. We have to be ready for it and we have to adapt to make the best use of globalization. Similarly, we have to make ourselves, comfortable with AI, and we have to create policies which is aligned with AI because AI is a reality. I also want to point out something interesting to you here. See, when for the first time computers came, around 1970s, etc. So, it took computers almost 20 years to be available across the world. 20 years time for penetration of computers. How much time did AI take to travel across the world? 3 to 5 years. That's it. It's traveling very fast. So, we also have to make fast changes in our policy to be ready to adapt the AI. So, let's start the chapter. So, you see, we are dividing this chapter into 3 parts. The first part, we are going to talk about some facts related to artificial intelligence. Then we are going to examine a very important question, that what is the impact of artificial intelligence on employment generation? What are the opportunities and what are the challenges? We are also going to look at the global AI models that exist in the world. So, there are basically 2 types of models. We are going to examine them. Now, the first model is called as top-down approach, and the second is called as bottom-up approach. We are going to see both of them. Then what is the advantage of AI for India and what are the challenges of AI for India? We are going to see all these things, right? So, as I was telling you that Economic Survey 24 talking about something else, 25 something else, we have seen that. Now, there is something interesting which is given. See, if you look at who is using AI across the world, so 58.4% of entire AI, which means close to 59% of the AI, artificial intelligence related infrastructure, is being used in the high income countries. 22.5% AI is being used in upper middle income countries like China, and 18.7% AI is used in lower middle income countries like India. So, what is the use of AI? So, if 100% AI is used across the world, around 60% is in high income countries, around 23% in let's say upper middle income country, and around 18% in lower middle income country. This is the share of use of AI of these countries. Now, McKinsey did one research, and McKinsey tried to find out by going to various companies across the world that are they using AI. So, for example, in 2022, McKinsey asked, let's say 100 companies that are you using AI? Only 50% of the companies said yes, we are using some form of AI. That percentage increased to 55, 72 and 88. Currently, McKinsey is asking 100 companies that are you using AI? 88 companies are saying yes, we are using some or the other form of AI. This is how AI has become common now. Now, we want to examine that what is the impact of AI on employment. For that purpose, what the Economic Survey has done is, Economic Survey has given a case study which was carried out in USA, because USA is using AI a lot. So, you can find out the impact of AI only when you go to a place which has sufficiently used AI, right? So, it has done a case study and it has found out that there is one service, a specific service, which is Professional Business and Information Services, PBIS, where a lot of AI has been used. So, here the case study has tried to find out that before AI was used in this particular field, which is Professional Business and Information Service, what was the level of employment generation? Then they tried to find out that when AI was introduced, what happened to the employment generation, and now they are finding out that after sufficient amount of AI has come, what is the employment generation. So they find out that initially when AI was introduced in the field of professional, business and information services, so those things which were done by people started to be done through computers. They find in the initial stage what happened is that suppose there is a company related to information technology. This company is producing goods worth 100 crore. When AI was introduced here, the company expanded, it created one more branch and its revenue increased to 150 crore. 100 became 150. And we saw that initially there were 2 people working, now 1 more person was employed. So employment actually increased. This guy was not very suitable to AI, so he was kept here. He was suitable to AI, so he was also shifted here. So which means now there are 2 people here and there is only 1 person here, but overall employment increased in the initial phase. But as more and more AI is coming, this guy who is not very good in AI, gone. So now what is happening is, as the companies are using more and more AI, no doubt that employment will be created, because even AI maintenance, repair and all those things require people, but the number of employment created initially when AI came was more, because companies were expanding, they required more workforce, some people were shifted here and there. But as the AI use is increasing, the employment generation capacity of the factories is coming down. That is the problem. So in the initial stage, more employment was generated with AI, there is no problem. But now we have found that employment elasticity, which means as more AI is used, the capacity to generate more employment is little down. So what are the challenges related to AI that we see across the world? That is something that we need to study. So see, something very important. If you see across the world, you will find out that the critical inputs, for example, supercomputers, data, some of the metal elements, etc., all these things are highly concentrated in some of the countries of the world. So there are some countries in the world who control the critical inputs and data. That is why the AI has one of the biggest challenges, that the development of AI is concentrated in a few countries. Number 2, regulation. We know that even today, the AI is not exceptionally present across the world. In some countries it is, in some countries like developing countries it is not. And in low income countries though, the use of AI is very less. So we see that different countries have different level of adoption of AI. Currently, it is not present in equal proportion everywhere. That's why different countries have created different rules and regulations. So global coordination in AI is missing. Number 3, entry barrier. You understand, when you use a lot of supercomputers, etc., you use a lot of digital technology, it consumes a lot of energy, electricity is consumed. And that creates entry barrier. So those countries where electricity is a problem, power is a problem, they are not sufficient, or those companies who cannot afford power, even if they can create AI, but they won't be able to allow to. The reason being, they will not be able to afford the electricity. So it creates entry barrier for countries as well as companies. And next is labor abundant economy. See, labor abundant economies like India, China, Brazil, etc., there is a problem. Problem is, the more the AI, more is the productivity and efficiency of the economy. But the problem will be that compromise of employment might happen according to economic survey. Some people will get employment, but some people, if they don't have the right skill, they might be displaced. That is a fear. Now, what are the advantages for India related to AI? So economic survey says that for India, one of the best advantages is low cost young labor force. So India has young labor force, low cost labor force. Number 2 is that India has diversified economy. So there are some countries in the world who follow only one type of pattern, like they will depend on oil, they will depend on natural resources, but India has diversified economic, for example, agriculture, industry, services. If we use AI, we can use AI in various sectors. So that is one of the good things about India. Third is, we are developing our own AI, so geopolitical pressure is going to impact India little less. If you depend on others for AI, you will be impacted. But if you create your own AI through research development, and there is a scope, for example, Government of India has started a mission called as India AI Mission, where we are trying to develop AI within India. So if we are able to do all those things, then geopolitically also we will be more strong. Next is, if you look at the labor force, skilled labor force, the skilled labor force of US is the best in terms of skill for AI, according to economic survey. The second best is India, which means that India has ready labor force, and with the right skill, Indian labor force can be one of the most competent force in the field of AI. US can be number one and India is very close number second in terms of skilled labor force which is competent enough to handle AI. Now, third is domestic data source. India can create its own data source. As I told you that 20% of the global data is generated in India. India just needs domestic data centers. Now, India is a late mover in AI. Sometimes when you enter a party late, it is good for you because you know how to behave in the party, right? You know which food is tasty, which is not. So similarly, India is a late mover to AI. So India knows which AI to pick up, how to do the research, what can be the downside, what is the positive side. India can plan well. That is what the economic survey says. Now, we are going to look at the two models of AI which are very prominently used across the world, and then we are going to see which model would suit India. The two models are, the first model is called top-down strategy, the second model is called as bottom-up strategy. What is the meaning of top-down strategy? See, in one of the strategies to make AI, what we do is we take very big companies. Like if you go to Germany, France, US, etc., what they'll do is they'll take very big companies. They will invest huge amount of money and they will create a lot of supercomputers. They will add a lot of semiconductor chips and all, and they will create artificial intelligence with huge computers, use of huge energy, and they will create AI for generic purpose. That AI can be literally used for everything. They don't create sector-specific AIs. They will create generic AI which can be used at multiple places. But creating a generic AI, and the generic AI that you create is called frontier model. Frontier model AI, which requires a lot of money, expenditure, energy, etc. Now, there is one problem associated with this. Only few companies and few countries will be able to do it because it requires huge upfront cost, maintenance cost, running cost, etc. On the contrary, if you look at India, India is a diversified economy. So government of India is saying we will not follow this strategy of creating frontier technology or frontier models. India will create model which is called as bottom-up approach, where we are going to allow multiple companies to enter the field of AI. And if a company wants to specialize, for example, in health-related AI or education-related AI, government says, I'll provide you the infrastructure and the help so that our system is more democratic in nature. So instead of giving a generic AI, which is frontier model, we are going to create distributed model where our AI will be suitable for a particular sector. We will create dedicated apps for different sectors. That is our approach to AI. Now, government of India is saying that we will create AI in such a way that our AI will be sufficient to be used in the existing hardware, which means that government of India says, I will promote that type of AI, artificial intelligence, which can be used in existing mobile phones in India, laptops, the smartphone that people carry. We don't need special gadgets. That's what India wants to create. India also is saying that we will create AI in India in 4 phases. There will be 4 phases of development of AI. What is phase 1? In phase 1, we will use the existing schemes like India AI mission. We will do more experiments. We will bring more companies, right? And here, the rules and regulations will be at a very basic stage. In phase 2, government says, we will select some of the companies, some of the AIs, and we'll make them big. That will be phase 2. And we will improve the rules and regulation. Phase 3, government says, we will go for international collaboration, cooperation, safety, security, and we will also go for skill development of workers in India, and our rules will become better. And in stage 4, government says, we will try to create that AI ecosystem in India so that our dependence on others for AI is as less as possible, and we will create an army of skilled labor force for AI. So these are the things that economic survey says, and then economic survey says what are the limitations that can create problem for India. So see, one of the problems is India has limited access to cutting edge computer infrastructure. We are trying to create computer infrastructure and lab under India AI mission, but we don't have the resources currently. That's number 1. Number 2, we have limited financial resources for large scale model training. If you create more AI, you need more training, and for that more resources are required. So that is one of the limitations we have. And the third is private participation in foundational AI research and development is limited. So government of India is saying that if you want to create a big AI infrastructure, first of all, at a very foundation level, at a basic level in phase 1, we need to invite more companies, the private sector, to do more experiments in AI. But our private sector participation is limited because of the training which is required, because of the resources, and because of the lack of infrastructure, which means that we need to provide that. What is the connection that you have seen in all the 3 chapters that we have seen today? In the 3 chapters that we saw today, we saw external sector. In external sector, we saw that agriculture, needs some reforms because we are the producer, we are not the largest exporter. Number 2, manufacturing needs reform. And in number 3, we have seen some services are not growing very fast, which are contact intensive services. There we need some reforms. Then we saw service is a savior. And then we saw that if we want artificial intelligence, then it might happen that some services might lose certain jobs. For that, we need to promote AI in different sectors based on the requirement, and we need to train our labor force so that all of a sudden unemployment does not happen. That's the connection between these chapters. That's why I took these chapters together. So thank you so much. Hope that you will make use of this learning for your exam purposes, and it will help you not only in understanding the government policies well, but also to score well in the exam. God bless you and study well.